I'm going to invite our first panel up, Twin Cities Apartment Market Update. Moderating this panel is Keith Collins, Executive Vice President for CBRE. So let's please welcome this first panel.
Good morning, everyone. Again, my name is Keith Collins, CBRE. I'll be moderating the first panel here. And again, we're going to kick it off with kind of a state of the apartment market, give you an update just where operations are trending, values. Unfortunately, they're coming down a little bit. We'll find out how much. But again, a great turnout. I remember Jeff Johnson asking me years ago, just, is this a good time of the year, to hold an apartment summit, mid-January? And, maybe we should do it in the spring, but look at the turnout. Yeah, every year we get about 600 people here, so great turnout. Thanks for coming. So again, I'm going to introduce the first panel, and then we'll get into some Q&A. So first off, to my left, we've got Matt Mullins. He's Vice President, Business Development, Maxfield Research. Next to him, Abe Roberts, First Vice President, Marcus and Millichap. Next, Ted Bickel, Managing Director at Northmarq. Left of him, or my left, would be Grant Campbell, Senior Vice President at Centerspace. And then further down, we have Josh Talberg. Josh is Managing Director for JLL. And last but not least, Chris Missling, Senior Vice President, Multifamily Sales at NAI Legacy. So thank you for participating. I'm going to kick it off. Well, Matt's going to kick it off for us. Matt's our research person on this panel. Grant's kind of works for a public REIT. He's got the ownership lens, and then the rest of us are kind of brokers. So, Matt, if you could maybe just give us an overview, where are rents today? Where are they trending? Our vacancies, and maybe just touch on the new development pipeline.
All right. Thank you, Keith. Good morning, everyone. Happy New Year. Great to be here. Another year in the apartment sector. Lots to talk about this year, given what's kind of evolved over the past year. But as we kind of set the stage here, I think we got to kind of look back first and see where we were at in 22. I think 22 as a year was almost record, pretty strong, right? I mean, we had really strong fundamentals. But as the year went along and we got into that third and fourth quarter, we started to see some cracks. Minor ones, but we see some softening and moderating in the market as the year came along. So we entered the year overall pretty strong metrics. But as we head into 23, I think the big question is, how does inflation impact renter households? What we've seen really is that the 40-year high inflation has really hit home on consumer confidence, which has led to household formations starting to stall out a little bit over the past quarter or two. So we're heading into 23 with another gangbuster year here with new supply. 22 we ended up about 12,000 units. A lot of that was suburban, 70%, which is where all this product is headed to, and that's a good thing considering the suburban market is performing well. But go to 23, we have another gangbuster year here. Got about another 12.1 expected to deliver in 23. A lot of that suburban again, about 2/3. But the one wild card is Minneapolis again. We've got over 3,000 units planned to deliver in Minneapolis in 23. And I think a lot of these units came about once the rent control initiative got passed. People wanted to get a shovel in the ground and kind of beat this new ordinance. So we had a lot of new product that was on the forefront trying to beat this new rent control, which we're still waiting to see what's going to happen down the road here. So a lot of new product coming in 23. To talk about vacancy rates, we're still sitting good. I mean, we're 13 years now, which is unheard of sub 5% vacancy rates. So killer vacancy rates, one of the best in the country. But again, we have urban-suburban divide. Core cities, most of the CBDs, are still suffering elevated vacancy rates. You know, we're hovering at 7 to 8% in Minneapolis and St. Paul and CBDs. Outside the CBDs, we're okay. Going to Uptown, North Loop, et cetera, we're doing great. Just the CBD submarkets that are suffering. So look at vacancy rates. Given the new supply and the state of the economy, consumer confidence, they're going to tick up in 23, no doubt about it. You know, how much they tick up, 75 basis points, 100 basis points, it's kind of the prediction as of right now. That could change, but we're going to see some movement there in the vacancy rate. Elephant in the room has been rent growth as we look at the Twin Cities compared to the rest of the country. And we're kind of at the bottom, right? I mean, look at the top 50 metros in the US, we're hovering, 48 for rent growth. We've had all these boom markets, the Phoenix, Nashville, Vegas, anything in Florida, Texas, where we've seen these double digit, that 20, 30% rent growth numbers, and we're hovering, 5%. However, even though we're at the bottom, I think we're actually puts us in a good position in 23 because these other markets are suffering now. You look at the Phoenixes, Nashville's, Vegas, the rent growth percentage come way down, but we're still holding strong. So yes, they were booming, phenomenal rent growth, but the Midwest here I think is steady Eddie and continues to perform well. So rent growth, I think we're going to subside again this year. We'll have positive rent growth, but we're not going to see 5% like last year. We may be more at that 1.5%, 2% by the end of the year, given all the new supply and what happens in the economy. The positive thing is absorption. Absorption has been phenomenal this past year. I mean, the Twin Cities was number 8 in the country for number of units absorbed. So all the new supply is hitting the market, but the good news is it's being absorbed, and it's being absorbed pretty nicely as far as pre-leases and whatnot and takedowns. So that's been a very positive in the marketplace. Concessions. Again, suburban, urban divide, the metro, CBDs are, still, 40 plus properties are offering concessions, 2 months, pretty standard, some with 3. Whereas you go to the burbs, it's mostly new construction, you maybe get a month free, pretty light in the burbs. But a lot of new construction is offering some concession. But I will say, we look at the rental townhomes and single family built for rent, zero, no concessions at all in that sector. That sector has been, very strong part of the market, and it's going to be strong too, given the state of the for sale market. So deliveries, concessions, rent growth. I think that's kind of my point. I feel we're on strong footing going into 23. There's going to be a little softening in the economy, consumer confidence, but overall as a market, we're not going to see this boom like we've seen since the pandemic housing boom, but I think we're still going to be on for, a decent performing year. It's just not going to be a record-setting year like we've seen over the past 2. So that's kind of a real quick recap of where we're at, and we can talk more about the outlook, I guess, as the morning progresses here.
Can you hear me?
Keep talking. Is it on? There's an on button on the front there. Put that up.
Hello?
There we go.
Okay, there we go. Follow up, Matt, as far as rent growth, I know you kind of mentioned maybe 1 to 2% this year. How about breaking that into urban and suburban? What will be your forecast there?
Yeah, that's a great question. I think back to the bigger question is urban, suburban, even A, B, and C, because your B and C properties have really fared very, very well as well. Coming through the past 2 years, I think the rent growth there could be stronger than some of the A product going forward in 23. But yeah, rent growth is fascinating. Even Minneapolis, though, considering all that's kind of evolved over the past 2 to 3 years in Minneapolis, we're still seeing rent growth despite concessions. I think we had 5% rent growth in Minneapolis this past year, which was really surprising, considering the marketplace and whatnot. But as I look at the suburbans, I would say, some of these suburbs had pretty phenomenal rent growth. I mean, we had 8, 9, 10, even 15% rent growth in some of these burbs that may have had, lack new product, go to Lakeville or Dakota County, and a lot of product down in that submarket has hit. So you had almost double-digit rent growth in some of those submarkets, whereas I say the older submarkets that have lack new product, say like Columbia Heights or some of the Fridley, you've seen rent growth in that 1-2%, whereas the burbs where the new product is being delivered, you're seeing pretty strong, almost double-digit rent growth. So it's really fascinating dynamic going on there. But overall, I think it's going to taper in 23.
And then maybe just, where do you see, vacancy as far as how low do you think occupancy goes? And again, kind of urban, suburban, generally speaking.
Yeah, I mean, that's the $1 million question right now is what's going to shake out in 23. I do feel like we, as a market, we probably, the vacancy rate goes 100 basis points, right? So maybe we could back up to that 5%, which is still equilibrium. It's still a good rate. So we've been at such low vacancy rates for so long. I do feel like Minneapolis is going to continue to have a little headaches, just given the amount of product that's going to hit in 23. They're going to have elevated vacancy rates. So we're still sitting 7.5%, 8% in Minneapolis, and that could continue to stay at that rate, I think, if not even tick up a little higher. But for the most part, most of the burbs today are still sub 3%. I mean, it's hard to go to a suburban area today and find a vacancy rate above 3. And those submarkets that is above 3, it's maybe Richfield, Bloomington, Shakopee, that have had such elevated new construction that it's risen, but they're still strong. I mean, even if you go to some of these new submarkets that have a ton of new construction, like in Edina, it's sitting at 5%. So I feel pretty good about the overall vacancy rate. I think we're going to still be, one of the lowest in the country, for that matter, in the coming year. It's going to go up, but it's still going to be low when compared to the rest of the MSAs nationwide.
My last follow-up before the deliveries you talked about the past 2 years. We've delivered about 12,000 units, 2/3 of that roughly suburban. And what does it look like for 24?
Well, 24. I mean, so far things are tapering back for 24. That's expected, right? I mean, look at the cost of debt service today, and what lenders are requiring and what underwriting is dictating for new construction. So we're definitely see a pullback in 24. I know our next panel is the lenders, so I'm sure they have a lot of good insight on what the requirements are for LTDs and whatnot. But I mean, I'm seeing deals certainly put in the back burner today, no question about it. A deal that penciled 3-6 months ago is not penciling today, and maybe a market that is questionable. So things are definitely pulling back. There's still a lot of projects in the planning phases and pending, or in some cases I've seen a lot where a building permit has been pulled, but that builder developer is holding, right? They're just kind of waiting to see how things shake out in the near term. Because I think most people feel that rates are going to come down. Just the question is when, right? How many times does the Fed keep pushing rates? And if they're really stick to that, we want 2% inflation. How many times they keep pushing rate hikes in 23. So I think that's going to continue to at least put projects on hold for 24 and 25. And I think our 24 numbers are going to be considerably lower than what we're seeing today in 23.
Do you want to take a guess what that is?
Oh boy. I mean, I looked at the numbers the other day. I mean, we've still have quite a few projects in the pipeline that are already under construction set to deliver. But I mean, do we hit, 8,000 units maybe? I think it's going to be at least a 30% decline from where we're at today, at least 30% plus.
Okay. Thanks, Matt. All right. I want to move over to sale activity and values. And when I to the apartment brokers to chime in. And just a couple comments. So from a national standpoint, and these are prelim numbers, I talked to our national folks, looks like there's going to be about 250 billion worth of apartments that traded last year, and that's down like 20% the year from 21. So just from a national standpoint. Looking at our market, last year, it looks like we traded about I guess with affordable, well, 2 billion traded last year in our market, and that's down from 2.4, 2.5 billion the year prior. So we're down roughly 23-24% for sale activity from my observations. But Josh, I know you guys have tracked this. Is any just commentary on the sale activity trends? Again, I think it was heavy in the first half, slow in the second half. What's kind of the outlook this year?
Yeah, I think it's a tale of two halves, right? So if you kind of dig a little deeper into that figure, our numbers are up, call it 15-20% year over year. Q4 was off 70% from Q4 of 2022. If you run a trailing 12, call it volume figure, going through the second half of 2022 through 21, we were tracking to be a $3.5 billion market. Everyone up here had deals that were in the pipeline ready to close in third quarter, fourth quarter of last year. Really, the paradigm shift in the Twin Cities, in my opinion, was, call it late summer, August through October, when you had the 10-year run 150 bips plus in that short period of time, and an asset class like real estate simply can't keep pace. So 22 will still be a success. That's a big number. It's $1 billion plus than where our market landed in 2020. But the reality was that was first half weighted. Second half, we all up here on this panel moved into the brokers, moved into what I would just say a price and discovery period. So it is really when that 10-year ran, any deals we were working on, the yield profile for those assets simply changed. What felt literally like overnight. Now I will say the Twin Cities, from a pricing, and we can talk percentages of value and kind of peak, from peak price into where we are today, our cap rates, fortunately, aren't moving from a 3 cap to a 5 cap, right? It was more a low 4 cap to a 5 cap discussion. So that bid ask was less than what you might find, and Grant could speak to this more, and the likes of some of the high growth markets that we're seeing incredible cap rate compression over the past few years. So for that reason, our bid ask on the majority of deals we're working on, it's like 3%, 2%. Buyers here, sellers here. And if we can simply just keep stability, we have a mid 3%, call it 10-year in the first quarter of 2023, that liquidity that's on the sidelines, I mean, there's investors in this room right now that have billions of dollars of equity that they're looking to deploy in the Twin Cities. That will be released in the market, which I expect will lead to 2023 to be a fairly active year. If we get more volatility and more uncertainty over the next quarter or two, that will look more like what the second half of 22 looked like. But we're fairly optimistic, and we think Twin Cities, Matt, to your points, has an incredible story from a fundamental standpoint, a great employer story, incomes, I mean, you go through and through, and that has led to names showing up in my experience that haven't been here for the last several years. They're looking to try to find a way to make a bet in the Twin Cities.
As far as values, I mean, you kind of hit on that, but just can you maybe just, where do we, think? I know it's hard to really predict everything right now because there's still not a lot of data points. But if we had a peg, Class A, like core plus value add, where do we think those cap rates are today?
Yeah, so Class A from peak is probably off, say 10 to 15%, right? That's more lower levered, unlevered buyers, and that's in the Twin Cities. That national market dependent, that's more in some cases. That's coming from, call it a low 4 cap to it's really positive leverage. So it's that 5 to mid 5 cap, clear visibility underwriting in the next year, 12, 18 months. The B and C space is where you've seen pricing come off 20, mid 20% in some cases, much more dependent on leverage, much more dependent on levered IRRs. And when you had our short-term rates run 400 basis points year over year, that has led to significant pressure in that asset class. So it's the older vintage product that we've seen pricing come in even more.
Ted, comments that you have on that, just value trends and just, from a national standpoint, at least our firm, I think the consensus is just, again, overall values are off 20% from the peak.
Yeah, I'd agree. And to kind of echo what Josh was saying, you definitely see it more in the value add space. Core, I agree with him, somewhere moving from the low 4s to 5+. I think the big challenge too last year was during that period of price discovery, trying to figure out where buyers would be active. And obviously you're gonna have select situations with 1031s or other motivations for purchasing, but it really was a period where we moved from low debt, low cap rates to just total uncertainty. I think now you're seeing some stability with where interest rates are leveling out, hopefully, but it's still hard if you have, if I have a call with a buyer, the first thing we're talking about is whether or not I'm trying to sell them an inverted cap rate. If the cap rates, if I start with a 4, the conversation usually kind of dies off, and I can sense that a lot of those buyers are still, quote unquote active from the perspective of just price discovery, like kicking tires, but they're not going to make any aggressive movement. So until our market sees that spread between buyer and seller dissipate somewhat and land, my assumption today is somewhere in like the low to mid 5s. It's hard to see any activity going forward. But you are seeing that. I think now there is some realization on the seller side too, like this is where things are leveling out. There has been an adjustment. It's different for value add versus core plus, but the more we can get some data points showing specifically where pricing is, the better. And I think if we see a number of deals trade the early part of this year, I'm expecting it's going to be a good year in 23.
Yeah, that inverted cap rate, commentary. Again, I think these other markets like the Phoenix, the Dallas, again, they were able to underwrite this, double-digit rent growth, and that's how they were really able to go, inverted from the cap rate standpoint. And now that's really, so to the Josh's comment about the national values coming down probably more than we've seen in Minneapolis. So that's why. Abe, maybe can you speak kind of more that small to mid cap? I mean, what are you sensing on value change there? Maybe again, I know you do a lot of urban as well. Just kind of the urban suburban commentary.
Yeah, absolutely. Good morning, and thanks again to Jeff for putting on this event this morning. I would just comment a little bit on what we're seeing in the Twin Cities Metro. We're seeing just a tremendous amount of capital still chasing deals. And every deal we bring out, if it's priced right, there's probably no surprise to anybody. If it's priced right, there is still a flood of capital and a flood of offers. It's that pricing discovery period, which Josh mentioned, that we're chasing up on every deal, and setting the seller's expectation up front this is what the market has done. This is where the market is at. If you're a seller, this is kind of where we need to be at. That being said, I think what I'm hearing from a lot of owners, operators, managers on the field is maybe not quite as rosy of a picture as Matt had pointed out. Again, there's pockets and every submarket specific, but I'm hearing a lot of vacancy. I'm hearing a lot of owners, managers saying, hey, my building has never suffered from a vacancy, and now I've got 10%, 5%, sometimes even more. So I know I don't want to be the pessimist on the panel, but I do want to share that because it probably goes back to kind of the first comments. Is there a concern of too much supply in the market? Possibly. I think that's been the feedback I'm receiving from owners in the field. Another thing is tenant apps, quality of tenants. Hearing that time and time again, it's harder and harder to find good quality tenants. The applications coming in used to be pretty easy to find a 625, 650 plus credit score, especially on the newer product. It's getting more and more difficult. So I don't know. One might argue and say, if you look at all the lease ups on the newer product being delivered, lease ups are surpassing pro forma and filling up, above expectation. I don't know, from the way I see it, I think that the absorption is pulling that Gen Z, tenant base, which are just super transient, mobile, and they're just hopping over to the next apartment building, which has a nicer amenity package or a little better deal. Maybe it's 1 or 2 months concession up front, but not necessarily creating more tenant base. And I think what we're seeing out there is, again, just owners kind of complaining, and there's feedback of there's maybe a little bit too much supply on market.
That makes sense. And to your point about the buyer and seller disconnection, and again, if they're aligned properly, and again, we just awarded a 7-property portfolio in the past couple of days, kind of workforce housing for someone on this panel, and the seller's expectations were aligned very well, and we saw a lot of interest. So that's, again, there's capital out there. And maybe I'll go to you, Grant, now, not necessarily on that portfolio, but maybe just you can kind of talk about just values in general, what you're seeing, and obviously you're active in Denver, some of these other markets, but just kind of how you're looking at Minneapolis, and we can kind of get into the public REIT market discussion as well. So I'll turn it over to you.
Sure. Thanks, Keith. Good morning, everyone. Happy New Year to everybody here today. Regarding cap rates and values, in the markets where we're spending the most time, we see cap rates up plus minus 125 basis points for reasons that others have mentioned here. I also think it's driven by the fact that, or our perception, I should say, is the bid-ask spread is the widest in the higher growth markets, the Denvers, the Nashvilles, the Austin, Raleigh, Charlotte, et cetera. I think that's driven by the fact that so many investments have been made in those markets over the past couple of years, and obviously nobody wants to post a loss. So unless you have a situation absolutely requiring a sale, people are holding and fighting for better days ahead in the capital markets. It's also, in my mind, the law of small and large numbers, if you will. If you bought a 3.5 cap and that is now a 4.5 cap, simple math, that's a 29 to 30% increase. If you bought a 5 cap and that's now a 6, that's a 20% increase. So although in both cases you have 100 basis points of cap rate expansion or widening, it is the case that in the higher growth markets you have more value deterioration, which again, I think is leading to a much wider bid-ask spread. If you look at assets that we priced 12 to 18 months ago in, let's just say, a Denver, if that was new construction, well located, great, compelling story in a micro location, that was pricing at a 3.5. Today, that is being underwritten at probably a 4 3/4. And in a lot of cases, you don't have a meeting of the minds between buyer and seller. So a lot of those deals are stalling out and not trading. Owners are choosing to hold, and perhaps we'll reevaluate moving forward. Maybe shifting gears to the broader REIT market. As Keith mentioned, we are structured as a public REIT. We're traded on the NYSE. Centerspace is an owner-operator of 15,000 apartment homes. Apartment REIT stocks were down 32% in 2022. That outpaces a midpoint 20% value reduction on hard asset multifamily communities. 20% is the kind of the same general number that that we see or that we've formed a view on in terms of value reductions. I expect that valuation delta to narrow in 2023 between public REIT valuations and private market valuations. It's also the case as we enter this year that the cost of equity and the cost of debt are both up. I don't think that is a surprise to anyone in this room. Those higher capital costs are certainly throttling investment velocity and transaction activity right now. There are still deals getting done. Investments are still being made, but certainly not at the record pace that we saw in the first half of 2022, when, in our opinion, the debt and equity markets essentially transacted 12 to 18 months worth of historical run rate transaction velocity in the first 6 to 7 months of 2022. So certainly a robust first half of the year, and obviously we've seen a significant slowdown. Some of the inputs there, one of the biggest is interest rate volatility. People want to know what the inputs are. They want to have confidence in their cost of capital assumptions. And I think we're going to need to see some extended period of interest rate equilibrium before people will have a higher degree of confidence in their cost of capital inputs. Until then, I think we're going to see large segments of capital continue to be on the sidelines, still desiring to be in multifamily, but they're going to wait until that confidence level has increased. And then one of the things I was thinking about here over the past couple of days is, how would I describe or characterize 2023 if I had to pick a few words? And the words I came up with were choppy, scrappy, and opportunistic. Choppy in the sense that we are entering a period of slower economic growth, weakening, or one could say normalized fundamentals, certainly inflationary expense pressures, record construction pipelines in certain markets, including the Twin Cities, as Matt alluded to. REITs are well positioned in this environment, given the equity capitalization of those businesses is permanent equity capital. Leverage levels are at historic lows. If you look at debt maturity schedules, there are very well laddered, predominantly long-term fixed rate debt maturity schedules, which is certainly a positive, but it's also absolutely the case that nobody wants to jeopardize those strengths right now, nor in theory in any environment, but in particular right now, nobody's going to jeopardize those strengths. So that gets back to the scrappy and the opportunistic words that, if one or if a group is going to find accretive investments this year, it's really going to be, a roll up your sleeves, opportunistic type approach in this cost of capital environment.
So Grant, is your house view then that you guys would be looking to see more stabilization before, more development, before Centerspace develops more, buys more? What's the house view there?
Yeah, that's a great question. We want to be active in all parts of the cycle. As Keith alluded to, we are selling some assets right now. We're selling in today's environment. It isn't the case that we then have to make investment decisions in yesterday's environment or with yesterday's pricing. So it is relative. We want to be active in all parts of the cycle. I think for us, where we have the best chances of success this year are one, on the development side, which you mentioned. We participate in development with our balance sheet. It's certainly getting harder to make math and structure pencil. If you looked at 20 development deals previously to find one or two that could work, you're looking at more than 20 today, because the math is breaking down, again, given costs of capital, construction costs, et cetera. But we would like to post a few of those this year where economics are supportable and submarket locations really have a compelling story. I think on the opportunistic side, we'll continue to be active in the operating partnership unit space, which, if you've heard me provide comments previously, that is an offering where asset owners can contribute assets into Centerspace for operating partnership units or shares And by doing that, they receive many structural benefits, including capital gains tax deferral, continued current income, the ability to step away from ownership, day-to-day ownership responsibilities. So I think you're going to see opportunities there. COVID has been jarring for a lot of folks. Current environment has been jarring. So I think we'll see opportunities there. And then in terms of straight cash, if you will, acquisitions, we are definitely trying to keep our balance sheet tidy. Leverage and liquidity considerations are real. So I think we will still pursue cash outlays, but it'll be at a much more measured pace than probably the last couple of years.
On the development side, what do you need to see today? Kind of return on cost metrics and just general commentary on what you're seeing for construction costs today I guess primarily in the Twin Cities here.
Yeah, so we're seeing from the development partners or groups that we talk to, some lines you're getting cost reductions or benefits, and other lines you're not. Net, we view it as neutral. Interest reserves are certainly up, and I know the lender panel and developer panel will talk more about that, but these heavy interest reserves and pro formas are really blowing a lot of them up. So again, cost of debt's up, cost of equity's up, no real relief on the construction cost side. To me, one of the other levers that you can pull is land prices. I think land prices have to come down if somebody truly wants to put a site into production or have a pro forma that can be supportable. Most of the development pro formas that we're receiving today, probably show up with a high 5s or 6 return on cost profile. When we put our overlay on that gets beaten up, as you could imagine. And, we're seeing a lot of them that at the end of the day, our math says those are 5.3, 5.5 type return on cost profiles with our overlay. And there's just not enough juice there. If you're going to build to a 5.3, you could perhaps go buy at a 5, and you really have to think about the risk reward in those two scenarios. So for us, structural components do come into play in terms of how do we price our capital, how do we participate in development with the idea and the expectation that we're going to own the asset long term. So that is an overlay and a lens that we do value. What is the price that we're ultimately going to pay for that asset, and how are we going to share in the upside with the developer? So I think we would have to be north of a 5.5, which sounds crazy to say, but if we could be 5.6, 5.7, 5.8, and then put some structural nuance on that transaction, there could be a path there that works for us.
Thanks, Grant. Josh, I guess a question for you, just on the maybe comment on you guys do work on some of the joint venture, new development, just kind of what you're seeing, the appetite there too. And then I want to get your kind of take on the buyer-seller types today. I mean, that we know the institutions a lot of them are on the sideline, not doing too much. So just general commentary on that.
Yeah, so I would add to Grant's comment on the joint venture, the equity. We do a lot of that work, both locally across the country. Grant made the comment that 20 plus deals they'll look at before they find one that fits. It is simple math, and the math has become really tough. So we are taking on some joint venture equity assignments, some fairly significant ones in the Twin Cities that we feel very good about. But these have some unique components to them that make them work. Grant hit on a few, whether it's land, whether it's location. I think TIF can be a big component to underwriting as well. We've had success in certain cities, that put support behind these projects, and then we can get that untrended yield on cost to a 6.5. We can trend it to a 7% yield. And to everyone's comments on this panel, that there is capital out there for those opportunities. It's Centerspace, whether it's the large private REIT vehicles, family offices. Multifamily remains a core asset class for many of these investors, but it's just simply the risk and return underwriting needs to align with new ground-up development. From a buyer profile, I will say that many of the names that own here have continued to be active, right? Twin Cities remains a core market for whether it's local, regional investors, or national groups. You've seen some of those names come across the wire over the past several months. We closed on a fairly large transaction in the early part of last year to a large top 10 pension fund. That particular asset was in Rochester, but for a lot of the same reasons kind of Matt touched on, from a fundamental standpoint, that was a $150 million plus bet. You don't see a lot of those show up in Minnesota, but in that case, it checked all the boxes. And you are seeing those type of names and very large blue chip investors who do recognize that. It's aligning again the bid and the ask, but I think if that gap closes over the next several months, you'll continue to see some of these very large groups that may have been spending more time in the Sun Belt or the coastal markets start moving into the Midwest due to stability and frankly just yields that are more aligned with today's marketplace.
Ted, what's your thoughts? Just, this actives, who's going to sell this year, generally speaking? Any general commentary on the buyer type? Is it, I know we've had a lot of new capital come into our market in the past years. We're going to continue to see that. Thoughts on that?
Well, I'd agree. Institutions, for the most part, seem like they're sidelined for the time being, and they don't want to be the first ones in. Obviously, there are exceptions to that, but the groups that have been active over the past 6 or 7 years are still here. They're still present. I went out with some clients yesterday, and the messaging is not negative for the Twin Cities. I think that the general idea is if you see pricing fall in line with where we're seeing it fall in line in other markets that we're active in, we're buyers here. But if it's a 4.5 cap, we're probably just going to be monitoring for the time being. So I think as you see sellers come around and adjust to where pricing is today and going into this year, I'd expect you're going to have the usual players, both local and national, buying here. We still get, not at the same pace we did prior to really COVID, but we still get inbound calls with investors looking to make a movement into the Twin Cities. The difference probably is that they're not as interested in Minneapolis or St. Paul proper for more political reasons, but suburbs are still healthy. I think we're seeing, despite some of the comments about slower rent growth and politics and whatnot, there still is that feeling that this is a fairly dependable, conservative, slow and steady market that you can look forward the next 12, 24 months and have a pathway to understand how to underwrite a deal, how to underwrite rent growth. To some of the comments that Abe made on the expense side, I think there is a lot of inflationary pressure on operating statements, specifically on the expenses. And I think that's something that buyers are trying to wrap their heads around, how to underwrite deals on the expense side, more so than on maybe revenue. But on the whole, I don't see a big adjustment with where, if we bring a value add or core plus deal out today, I don't see a lot of different players involved than maybe 12 months ago, but I think the appetite's still there. And we had the same experience, I don't want to appear to be too negative, going back to last 6 months of last year. I still think we have the same amount of activity in terms of calls and tours that we would have in previous to the change in interest rates. I just think that we got to get to that, and the word keeps coming up, equilibrium. We got to find out where is the market? What's the cap rate? Where is the cost of debt? Are sellers willing to execute there? Or is the buyer wasting their time? And once we get there, which I feel like that's coming this year, I expect we'll be back on pace with historical trends in terms of transactions.
That portfolio I just mentioned that we did see some new capital, bid on that, and it's just we want to get into Minnesota, the Twin Cities. Some of this product was in St. Cloud. They just kind of viewed St. Cloud as part of the Twin Cities, but it was good. But what do you think? St. Paul has modified their rent control policy. Minneapolis is still talking about rent control. What is that impact that's having on the capital that's looking at deals today?
I think it just takes out a chunk of the buyers right from the start. So just say 25% of the buyers right away, it's a non-starter. And the conversation is very simple. We'll talk about it. I'll explain, my personal opinion or viewpoints in media or whatnot about rent control. And the comments like, why would I make a bet there if I'm going to look stupid if something happens, whether that's now or a year from now if the politics swing in a different direction. So that has been hard, and I think it will be hard going forward. But again, like that's 25% of the buyer pool. I still think you have 75% of the groups that are still willing to consider it. But obviously, it'd be great to have more certainty around what rent control might look like. I mean, I'm assuming it's not going to happen in Minneapolis, but if it did, what it looks like and what the adjustment in St. Paul will be, not just this year, but in future years. And the adjustments too, I mean, I don't know how punitive it really would be if they follow through with some of the proposals currently, but that's been hard. And I think that hurts just the general transaction volume, obviously, because we had a lot of deal volume and number of transactions tied up in the cities, and that's died off specifically over the last 18 months. But yeah, I think the further we get into this year and get more clarity on where the cities stand on rent control, the better. But yeah, there's no question. If you were to ask me, would I rather take a deal out in the suburbs versus the cities? It's clear suburbs. There's no question. I mean, it's not just marginally easier. It's a much easier sale, and it's much easier story to tell a buyer. Where you look back 18 months ago, 2 years ago, it was probably the opposite.
Grant, what's your take? I mean, just again, Minneapolis, just kind of how the pros and cons of Minneapolis from an owner-buyer standpoint today.
Yeah, and before I go there, just one thought on St. Paul from a slightly different lens. We own one community in downtown St. Paul. It represents a very, very small portion of our overall NOI or cash flow in our business. Yet from outside our walls, whether it be analysts who write research on us or investors, current or potential investors, folks from outside the Twin Cities, that one community represents that very small portion of NOI, but it may represent 25% of the questions and the phone calls we get and the discussions that those folks want to have regarding our business and our portfolio. So to Ted's point, folks from outside our market who may not understand the nuances yet or aren't going to invest the time to understand the nuances, some of those folks just view it as a red X. And, St. Paul is off the list. It's a big world. There's a lot of places where you can spend your time and energy. We're not going to spend it in St. Paul for rent control reasons. In the case of Minneapolis, similar themes and discussions that we're having with people outside our walls on, is Minneapolis going to enact rent control? Is it going to look like St. Paul? I agree with Ted. I hope that it does not. I think there's a whole host of downstream considerations that many of us are thinking about, or if you haven't yet, I would encourage you to seek resources and discussion to think about the downstream considerations. And I know this isn't a rent control panel, so we won't spend an hour on that, but we're long the Twin Cities. We're going to continue to own and operate here. We view it as a great, I don't want to say complementary market, but it does price differently than some of the higher growth markets where we spend time. But we're long Twin Cities. You look at the employment base, the steady Eddie nature of it. It's great in these sorts of times. So we're going to continue to be active here. You will see us, as we have been doing, continue to improve our portfolio quality. So the composition of our holdings in this market it has changed, likely will continue to change as we move through time, but we're definitely going to continue to be here, continue to invest capital here, and think it's a great market for us in the broader spectrum of our portfolio.
Thanks, Grant. Abe, just comments from you just on the buyer-seller type, in that kind of more small to mid cap. 1031 used to be a big, source of capital. I assume that's kind of, died down just with the lack of velocity. Just general commentary on who's selling, who's buying today.
Yeah, I mean, in general, the market is, as many of you know, it's slowed down tremendously. I think the people who are considering a sale, a lot of them are just very in tune to what the market is doing and what they foresee happening in the next 12 to 24 months, call it, as a result of the rent control ordinances that have taken place and they expect to take place. So I think those are a lot of the sellers on the sidelines right now, or I should say who are considering a sale. As far as buyers, I think there's a handful of, as Keith mentioned earlier, of newer, fresh capital, surprisingly, that's kind of come up a little bit and say, hey, if there's an opportunity here, if they sense that there's, to buy something at a decent discount, we'll see a lot of that. We had a larger deal on market, and $70 million range, and we had a cash offer saying, hey, I'm not at your 70 million, but I can close in 15 days. It's not going to be at 70. So there's a ton of capital out there. But as far as sellers, I think rent control is going to be the biggest hot point that has been motivating owners who've been in the business for quite a while to say, hey, maybe now is the time. One more point, I think the biggest hurdle we're seeing as far as owners who kind of are ready for a sale but won't pull the trigger now, I think a lot of it is just kind of the mental, psychological aspect of, hey, year over year, you've been telling me the last 10 years that my building is worth 10% more, 10% more, 10% more. And now we're going back to them and saying, hey, it's actually worth 20% less. Do you want to sell? And so I think the pullback is, I don't want to leave money on the table. I don't want to lose money. And so that's where we're seeing a lot of pullback. I mean, obviously, big picture, they've done very well. And even if now is time for a sale, if now is a time for a sale, then you should consider it.
How about underwriting? I think Ted or Grant, commented on that, just how that's changing. What are you seeing? I mean, insurance costs they're going up, and how are you seeing buyers underwriting your deals?
Yeah, I mean, that's good. That's again one of the biggest things we're getting pushback from buyers is insurance has gone up about 40-50% over the last couple of years. Real estate taxes, especially in the urban core of Minneapolis, St. Paul, if you're looking at real estate taxes and rents are capped at 3% and taxes have gone up more than that, I mean, that's a pretty big deal. I think we'll see some softening in real estate taxes in the next 12 to 18 months, hopefully. There's some assessors I've spotted in the audience here, so hopefully
They've heard the 20% comment.
20% is fine. It'll help our deals pencil out a little
25.
better. So I think real estate taxes, insurance, it's a lot of pressure on our expense ratios. But then in general, payroll expenses have only gone up, and rent control kind of puts a cap on what we can charge to make up for that. So that has been a struggle. We've been raising our expense ratio averages, if you will, on a lot of our deals, just to price per unit, expenses on a price per unit basis. It's all been only heading upwards. And
maybe quick thought there. You mentioned insurance and taxes. Two other areas, staffing, which you alluded to. Staffing costs are running. It's getting increasingly harder to find top quality on-site talent, both in the office and maintenance roles. It's hard to find it. It's hard to retain it, and doing both of those things is costing significantly more than it did. I think that's a combination of not as many people pursuing those career avenues today, as well as folks in the trades that have recently left the trades to pursue alternative employment opportunities. So we are definitely seeing that within our owned asset portfolio. Also on the utility side, we are getting hit very, very hard on utilities, both from a modest increase in the usage of utilities, but more so a very large and significant increase in the underlying cost of the commodity. So utility expense increases have been jarring here over the past 12 to 18 months.
Is that work from home, the usage?
Yeah, I think that is a contributing factor to the usage portion, the underlying costs of the commodity. I mean, some of these increases that we're seeing are jarring.
Well, I'd like to add too, so we basically touched on all the expense line items except for like management fees. And that business is really hard, so I think a lot of what we're doing now, like coaching wise, is to talk to owners if they're gonna sell, like, hey, we can't control where interest rates are, obviously can't control like buyer interest levels or activity at any moment, but if we can shore up your income statement and really focus on all those expense items we kind of talked about. Some of them, if you investigate, they are what they are, but trying to shore that up. And also on the revenue side, obviously we've faced a lot of bad debt and concessions and vacancy related to the eviction moratorium and other fallout. So I think trying to work with owners on saying, hey, let's spend a couple months, let's get your income and expenses tight so that we can show a buyer a couple months of trailing numbers that are reflective of where the buyer should be after they close. That's super important. That's one thing that I think owners can control and focus on.
The agencies are going to take the T1 largely, and if there's concessions built in that T1, you're going to get dinged, and then that's where you see leverage come off, leverage returns, and I think that's the final point. It's the growth that investors are underwriting today. A year ago, 2 years ago, especially in the Phoenix and the Denvers of the world, we were living in year 2, year 3, 7, 10-year projected models. Today, that's pulled back to year 1, next 12, 18 months. Clear visibility to positive leverage is really what we're all up here trying to solve for.
I wish we could rely solely on a T1 when we were underwriting a deal.
Imagine, again, we've got one of the lowest unemployments, in the country, and obviously that's a contributor why I think some of these, it's hard to find, people. And one buyer in particular is just like, we're kind of pausing Minneapolis, we just can't find any people. So I think it's gotten a little bit better in the last few months, but just any comments you have just on our local economy.
Sure, yeah. Well, it's been fascinating. I guess kind of pull it back a little bit from a population standpoint. Are we on here? Good, all right. From a population standpoint, since the pandemic hit in 2020, we're hovering like number 31 in the country right now from a pure population growth. So we have not had a whole lot of new, workforce come to the market. So, our unemployment rate basically the lowest in the country. Got, we're like a 3 for every job open, we got 3 people unemployed. So the highest ratio in the country. So, employers are desperate right now to find, bodies to fill jobs today. So we have a healthy economy, a lot of jobs, but just not enough bodies, moving to our state right now to fill all of our, job openings. So, but overall, we like it. We got, all these Fortune 500 companies. Our wages are among the highest in the country. We have, from a rent standpoint, our rent to income ratios are among the lowest in the country. So it's a great market, to be a renter and a home buyer in. But there are also hiccups right now, as far as the economy. We need more bodies for all our jobs in the state, especially even more so in outstate Minnesota. You go to outstate Minnesota, whether it's Worthington or Warroad or you name it, anywhere across the state, they're so desperate for workers and for housing. You go to these cities, you name it, they all have a huge insatiable need for rental housing, as well as workforce housing, just workforce in general. So yeah, it's a interesting time. I think the jobs are there. It's a great time to be looking for a job. It's just we need more inflow coming in to help fill all the opportunities right now.
Thanks.
I actually have a question for any of the brokers on the panel in terms of perception of the Twin Cities or the highest degree of confidence in the Twin Cities. Are you seeing any differentiation between groups that have already been here, owned and operated here, versus capital that hasn't yet entered the market? Is either one of those pools expressing higher degrees of confidence in investing in our market?
I don't know if I'd say there's a theme, given like I said, there are caveats. Or we sold a deal last year to a new entrant from Seattle, a core plus deal. I'd say it's much more varied. Like you're seeing certain groups in the cities for even reasons we were talking about now on the management side. Like they're just saying like, hey, we're having trouble staffing, our expense loads are up. We're probably focused on other markets for those reasons. Or you've got a group that's a new entrant and they're looking for third-party management, and that ends up being a hiccup. So I don't think I have seen a theme emerge yet, but that's something to pay attention to this year.
I think from an institutional standpoint, Grant, I think the institutions, they view the Minneapolis, kind of that steady Eddie, they like that. Their preference is suburbs. I think a lot of institutions, unfortunately, have not had a good experience in urban in general, but a lot of urban, we've had a lot of pension fund advisors, life insurance companies that, built and provide equity downtown Minneapolis or uptown, and they just have not had a good experience. So for them to get back in to Minneapolis or the Twin Cities, they'll probably need to go suburbs first or have someone prove it in the urban before they come back.
Sure.
So that's kind of my take.
Sure.
Yeah, I'd just add, I do think the Twin Cities, I've had a lot of conversations with groups, whether it's private REIT vehicles, whatever it might be, that might not own in the Twin Cities, but see it, I think especially today, as growth is starting to pull back in other parts of the country, they find it as a place in the portfolio, kind of that stable asset that they can project in the future, good going in yields, versus just the high volatility you're seeing in other parts of the country right now. And I've heard that feedback from groups who might not have a presence here in the Twin Cities today. Sure.
Chris, I haven't forgot about you. I know you kind of left us, but then you came back. So, again, I know you do a lot with fundraising, raising money, in that 1031 space, but just if you want to just give us a.
Yeah, sure, absolutely. So, for our company, NA Legacy, not only are we brokers in different asset classes, but, we are also a national DST sponsor. So last year, there was about $8 billion of DST transactions that happened in the country, and half of that was multifamily. And I know there was a big one here in Minnesota that happened. It's a 524 unit that was a DST structure. But really what that does is, it's another entity vehicle that holds the properties. And then another entity is created where we become the managers, and then we bring in equity from investors, throughout the country. And a lot of that is, equity and 1031 exchanges from, generational owner operators that have, been in the business for about 20 plus years, and they decide that they want to move out of that active role and just kind of go into more of a passive role, but still enjoy, distributions, deferring capital gain taxes, and enjoy the equity share and appreciation. So, for our office, last year it did slow down. We had probably about a dozen or so deals that we were looking at under contract, and we ended up backing out a lot of them because of the interest rates that did spike. Our numbers didn't pencil in, but we still ended up closing on 3 deals last year. And so that brought up our number of properties to a total of 37 properties across 8 states. And we were still able to manage to raise about $3 million in equity last year. So that, for us, we're going to still keep going forward this year. We have a pipeline of deals that we're looking at, and we're helping others kind of move into that space of going from active to passive roles. And a lot of that money is coming from other states besides just Minnesota. So I think we had investors from 32 different states that have brought money here to Minnesota. So I think, from what I'm seeing on my side is, that people, are looking in the state of Minnesota, and they see it as a very stable place to invest.
Thanks, Chris. I know we may get 5 minutes here, so I'm going to try to How about if, and make it quick, if we can, kind of a speed round. I'll start with Josh here, just opportunities for people. But where are the best opportunities today?
I do think the newer construction space, maybe it's recently built product. I would even venture in the Minneapolis, St. Paul areas as well. I think there, it's a kind of an investor quote that in the short term, markets tend to be a voting machine, long term a weighing machine. I think if you look at the infrastructure of a Minneapolis, even a St. Paul, and if you can buy great assets at, in a lot of cases today, well below what it would cost to replicate that same asset, and simply take a longer term viewpoint on that real estate, and there's supply issues in certain pockets, there's an employer story that needs to play out, but from a 3, 5, 7-year projection, that there feels like there's some incredible intrinsic value that I think someone could acquire today if you're taking a longer term bet. And those deals aren't easy to find because most sellers recognize that as well. But to Grant's comment earlier, if you're working at it, there will be opportunities, there will be sellers for certain reasons, redemptions, etc. If you're leaning in and just taking that long-term viewpoint, the Twin Cities, I think is positioned to be a great story for the next several years.
Grant?
Thanks. I mentioned our operating partnership unit discussions and development participation discussions that we're having. We'll place a lot of focus there this year. I also think about refinance and recapitalization risk. I think there's going to be opportunities for some resulting from a large swath of deals that relied on short-term floating rate bridge debt here over the past 2-3 years. And I also think about some of those deals or others that have interest rate caps in place, maybe put in place 18 to 24 months ago. And I think some folks are going to have difficulty repricing those caps today. And we're seeing that and hearing that. So that's another space that I think about as opportunity for some.
I think there's a big opportunity with loan assumptions. So if you're an owner that has debt with, at least 3 years, preferably 5 or 7 years of fixed rate still on it with a decent balance that sizes to where pricing is today, that's a huge opportunity. I think you're really selling the debt along with the asset, and arguably, or she should be getting better pricing than someone that's coming in and buying it conventionally and placing new debt.
I'd say to echo Josh, Minneapolis, St. Paul, I think there's going to be some huge opportunities. There already is. A quick story, I called what would be a buyer in the Minneapolis market on a deal all day long, would trade 125 to 130 a door. I tried pitching him the deal. I didn't tell him a price, and he said, what do you want for this one, 125 or more? And I said, we were fine with 105 a door. And I said, write it up at 125. That would probably get it done. They came back and looked at it and said, well, I'm going to sound fine. So I think there's a ton of opportunity. Again, really, really low cost basis. Somebody who believes in the Minneapolis or St. Paul market that they're going to come back.
I would reiterate a lot of the themes about the Midwest. I do feel that going to 23 and 24, the Midwest is going to be, I'll get back to the steady Eddie comment. A lot of people are going to look at the Midwest. It's a strong, steady market versus the more volatile coastal markets up and down. So I think we're going to see a lot more investment come into this market. I tend to be more on the development side of things. Front end of deals. I think there's going to be a lot more opportunity in single family built for rent. A lot of builders, I think, are going to start disposing of for sale homes to get in the market. These buy downs, so there's going to be a lot more opportunity to start purchasing maybe some single family in bulk and doing single family rentals. Rental townhomes are hot. Anything in the tertiary markets, outstate Minnesota. I think a lot of cities are open for business to go in there, get TIF, tax abatement, some free land, work some other workforce grants. I think there's going to be a lot more opportunities out there in these tertiary markets that they really want to work with you to make a deal done. So I think that's, there can be some hot markets in outstate Minnesota as well. So overall, I think, there's going to be some opportunities in the commercial side as well. If we get distressed assets potentially in hotel, office, do we have some conversions on that coming down the pipeline? And there are a few deals right now in the pipeline, Sherman, so there's projects on 494 Strip, starting to acquire some commercial assets for pennies on the dollar. So I think we're going to see more and more of those properties pop the next year, given the state of the office market.
I'll just say, I think there'll be, the opportunity I see is the institutions that have been maybe hesitant to come down to market and sell. I think they will start to. And I think there'll be some good opportunities to buy from the institutions probably, in the first half of this year. We have one in particular, downtown Minneapolis, high-rise that we're bringing out in a couple weeks. And an example there, our pricing guidance is going to be probably 50% of replacement cost today. So there's an opportunity. So I think I'm a little over, but I think that's kind of a wrap. So let's thank the panelists for their time. And
All right. 925 panel, capital markets, getting it started. Moderating the panel, Lucas Goring. He's Vice President of Bellwether Enterprise. So let's please welcome Lucas and his panel.
Morning, I'm Lucas Goring. We got the capital markets update here. I think to piggyback a little bit off that last panel, Josh and Ted kept talking about equilibrium, and that's one thing we've brought up quite a bit. On the sales side, obviously the debt's pretty important. We started to see the Treasury level off in that 3.5 to 375. And once everybody kind of knows what the rules of the game are, it seems like the game is starting up a little bit again. So I guess that's just, equilibrium is going to keep coming up in our panel, and I would assume the rest of the day. So I think to get started, we'll just go through some introductions here. Let's start way at the end.
Yeah, down here by my friends. Good morning, everybody. Brett Olson, Senior Vice President, Grandbridge Real Estate Capital. We're a full-service mortgage banking firm based out of Charlotte, with about 26 offices throughout the country. My focus, a lot of multifamily debt. We represent Fannie Mae, Freddie Mac, FHA, HUD, along with a number of different life insurance companies and banking relationships.
Hi, good morning. My name is Nick Place. I'm the Chief Lending Officer at Bridgewater Bank. We're a local bank with about $4.3 billion in assets. 90% of our lending here is within the Minneapolis-St. Paul market. Multifamily is our largest single asset class. It represents roughly 30% of our portfolio. We're active in sort of all aspects of multifamily finance, from small market rate transactions to construction and affordable housing.
Hello, everyone. My name is Fritz Walvogel. I'm with Colliers Mortgage. We're a commercial real estate lender based here in the Twin Cities. On the apartment side, we focus on market rate housing, affordable housing, and senior housing all across the country via agency relationships, Fannie and Freddie, as well as HUD, FHA, and life insurance companies.
Good morning. My name is Andy Deckas. I run a company called Axial Real Estate Advisors. As the name implies, we advise high net worth families and separate account offices, primarily in the apartment space. We've got about 25 properties, about $1 billion of assets under management. Average transaction size is probably $40 million, and we've got about 4,000 units that we operate in the multifamily space.
Todd Dexheimer, with principal with Endurus Capital. We own about $500 million of real estate, mostly multifamily, about 4,000 units of multifamily and senior housing, and then a little bit of retail and industrial.
Great. So the topic we've talked about quite a bit is interest rates and how that's affected the multifamily, just real estate in general. Todd, from a owner's perspective, what's changed between now and 8 months ago?
Well, obviously a lot, right? Interest rates and just the overall environment. We've seen rents 8 months ago, we're in several markets. We're in Kentucky, Tennessee, Minnesota, and so we're seeing a little bit of different things. Kind of similar markets, right? Midwest, slow-moving markets, but saw a lot higher rent growth in Tennessee and Kentucky than we did in Minnesota. Pandemic hit, Minneapolis, Twin Cities saw that rent decline. We didn't see that in those other markets. And we saw a little bit higher rent growth. And now, obviously now, in all those markets, we're seeing rents just completely relax, if not go down, right? We're seeing right now rents going down year over year. We're still a little bit positive, but certainly that is just volume overall of deals, opportunities. We're still net buyers. We want to continue to grow the company, but there's just a difference in sellers. Sellers want prices that they could get at the beginning of 2022, and we want prices that are realistic for today. So yeah, I mean, just in a nutshell, that's a lot of differences.
Nick, from a lending side, there's been some changes here in the past 6 months. To piggyback off Todd, what's different now, probably more leverage-wise and rate-wise from what Todd was saying?
Yeah, I think, if we rewind to where we were sitting on these panels a year ago, inflation was a topic, but, I'm sure everybody remembers the word transitory. So that was sort of the topic or the commentary du jour back then. I think that's proven that, inflation was a bit more persistent than what many of us had expected. And if both us as lenders and prudent owners, you try to project forward as to what environments are going to look like. I don't think anyone that was listened to anyway projected the pace and volume of rate increases that we've seen over the last 12 months. So, you mentioned leverage. The last panel was talking about, where are banks thinking about from a leverage perspective. I can't think of a deal that we've looked at lately that's been leverage constrained. All of our transactions that we look at today are debt service coverage constrained. We've talked through plenty of examples on our pre-call, but the leverage, because of how appraisals in general and us thinking about cap rates work, those are all trailing indicators, right? Those are things that we're looking at from transactions that happened, anywhere from 12 months ago. And interest rates that we're looking at are real time. So we're trying to project forward what are interest rates at today, what are we going to have for a sort of a terminal interest rate on a takeout, and we're trying to size our transactions to those takeout rates, which, as we've known, have been doing nothing but going up over the last 12 months. So, being a debt lender and being conservative in nature, we're trying to project forward rates that are giving us some cushion as to where current takeout rates are, so that we don't end up in a situation where we're relying on a takeout if we're doing a bridge loan or a construction loan, and we're sizing to today's rates, and for some reason rates 2-3 years from now are higher. We need to have a cushion there. So because we've increased our sizing rate, that has had a really meaningful reduction in loan proceeds on just about every transaction. So whether it's a new construction transaction, and I can maybe share some details on something that we've looked at recently, or even just a simple stabilized acquisition, the same NOI dollars that you had before can support a smaller loan amount than it used to. So, that just requires buyers to get more creative. They either need to have, ample capital to right-size that loan to make it work, which, as the prior panel talked about, really impacts sort of returns for investors, or they need to have, creative solutions through utilizing, other forms of capital, whether that be, city funds or grants or TIF or other things to make projects work.
Yeah, and I think we all got pretty spoiled the past 3 years of getting rates with some 2s on the front or some 3s. I remember when I worked at Venture Mortgage for Mick Thorsland, he would tell the stories, and I'm sure everybody familiar with them, of you get an interest rate with a single digit on it and the borrowers were just thrilled. So being where we're at now at the 5.5, historically isn't bad. It's just the perspective of having 2 years ago getting interest rates at 2.5 is a little challenging. Andy, with the rates and more equity required, how does that affect your business of raising the capital?
It's challenging. I think just to kind of take a step backward, I actually made a living for decades in the commercial space, and pivoted maybe 5 or 6 years ago. And again, we represent high net worth and family offices, and it's my opinion, and I think probably shared by everybody in this room, if you're in that category, multifamily is, in my opinion, the most reliable way to, if you do it right, to preserve capital and have predictable income streams. A couple big rules when you do that. One, you have to have a long-term perspective. Ideally, you have a long-term debt execution model, and patience. And so this is why you invest in multifamily for situations like this. If you do it right, we've got some headwinds here, but if you've got a long-term perspective and you've got long-term debt in place, you don't have a fund maturity staring you down, you tread water. And maybe you're not going to get the 8, 9, 10% cash yields for a couple of years, but you're still going to be positive. And maybe you're not going to get the 20 IRR like you had hoped, but you're still going to get something that's pretty good. So I think for those of us who have those situations, we sit back and kind of, I don't want to say enjoy the ride, but it's not going to be so bad. Where you get into trouble right now is if you didn't abide by those rules and you're in a situation where you either have to sell because that's what you told your investors you were going to do, or worse yet, you've got a technical fund maturity, or you didn't lock your debt. And so, I think from a standpoint of our existing portfolio, we're in really good shape and happy about that. We've got a couple situations where we didn't mind those rules that we're navigating through. What are we going to do with this floating rate debt that's double or triple what we thought it was going to be? In terms of new deals, there again, I'd say it's situational. The wave and the herd mentality, if you will, is taking a pause. There's still I believe, going to be displacement, but as we talked about, there's still a gap between seller expectations and buyer needs. Ultimately, I think that's going to shift, but we're pencils down on a lot of things, but not everything right now. And I think there's going to be opportunity. The smart family office money is hoarding cash right now, getting ready for when's that going to be. I can't tell you exactly, but there's a lot of capital out there that at the right time will re-enter this space. And so we're trying to get ready for that.
A real-time example, Andy and I just wrapped up a deal right before Christmas, and we were supposed to close in the middle of the summer, and at that time we needed about 30% equity. For market reasons, it went through the summer into December. That closed at about 38% equity. I think we had a 61 or 62% loan, and that was a full loan.
Yeah, well, I just wanted to add to you're talking private equity. So 2022 was to me, a really interesting year. When we saw equity was super easy to raise at the beginning, and then all of a sudden interest rates and inflation, and that was like the talk of the town, and then equity was extremely hard. And this was talking like April time, very hard to raise for just a short period of time. We did one raise, and it was actually a smaller raise than the one we did earlier in the year. It was a lot of work to get that deal done. Fast forward to September, October, I think it was August and September, we did 2 raises. Both of those raises, we raised within 24 hours. I mean, just super easy to get those done. And then to cap the year off, I had more equity than I've ever had reach out to me trying to place money into our deals. And so the money's still there. I think we've seen the market, took that shift. Everybody's like, oh, what's going on? And now we've seen maybe a little more stabilization. And so I think the equity's back. Now, the end of the year, people wanted to get the 100% bonus depreciation. So that plays into it as well. So we'll see. We don't have any active raises going on, but we'll see what happens the next active raise and what the appetite is. But right now, it seems like the appetite is really strong.
And Fritz and Brett, you guys talk to quite a few people and your clients. What's the overall thought process for them at this point with rates jumping up?
I can jump in. You know, what's a little different in kind of this cycle that we're in today is I think a lot of our clients anticipated an increase in interest rates. I don't think we thought they would increase as much as they have. You know, a year back from today, the 10-year Treasury was roughly 175, and we're today at 3.5. So obviously a large increase, but a lot of our clients, got ahead of it. The first half of 2022 was, our highest volume. We closed the year with a record year in 2023 with very little activity, the back half of the third quarter and first half of fourth quarter. So, our borrowers have had to pivot, I think. A lot of long-term borrowers that have been used to doing the Fannie Mae, Freddie Mac 10-year, 30-year amortization deal, get some interest only. We're okay doing that execution, especially when rates were 3.5% to 4%. They were long-term holders. They had no expectations to prepay that. Now today, we've got a lot of borrowers that, have the crystal ball that rates have hopefully peaked or close to peaking now, with rates, dropping potentially in the back half of 2023, and more certainty of dropping in 2024. So we've seen our borrowers pivot a little bit. We did more bank executions, staying shorter, whether that was floating and taking that risk, or working with banks on unique structures of, maybe trying to just do a 5-year fix on balance sheet with a bank, buying a cap, maybe an internal cap with a forward swap, to try to kind of keep that coupon but maintain flexibility. I think that's been the biggest thing with our clients today, is they're okay refinancing to a 5.5% to 6% interest rate today, as long as they maintain the flexibility and can come back and execute if rates drop again at 4.5 and not have a prepayment penalty that's too onerous. So a bit of a shift in their thinking. The other thing too, I would say on the long-term debt side, specifically Fannie and Freddie, as leverage has come down due to debt service coverage constraint, interest only has been readily available, and that's been solving some issues, especially as developers are trying to solve for a yield for their investors. So utilizing, a full-term interest only loan with Fannie or Freddie. So a lot of clients, again, paying a higher interest rate than what they'd like to do, but getting 10 years of interest only to really help on the cash flow side.
No, I'd echo a lot of things Brett said. Obviously, a lot of our clients did the same thing and locked in with 3 handles and things like that with longer term hold periods. But I think just generally, I do a decent amount of work in the Sun Belt as well, and I think the previous panel echoed it a little bit in terms of the really high growth, low cap rate environment, especially in the B and C space. Traditionally, especially I would go back to 2020, Fannie and Freddie still did a lot of the acquisition work just across the country. And then starting really in 21 as rent growth really took off, and we got into early 22, bridge lending in particular took over most of that acquisition business. So, I would say traditionally Fannie and Freddie have been a balance like 50% refinance and about 50% acquisition. Into 22, that pivoted to probably about 75 to 80% refinance, and only to 20 to 25% acquisition because of basic, buyers were assuming a lot of rent growth, and Fannie was only able to underwrite to T1. And so now you're in a situation where, if cap rates move from 4% to 5%, hypothetically, you had a $1 million of NOI when you bought the deal, and you had a value add, and you've gotten some rent growth, and now you say you can go up to a 5 cap. Basically most of that equity is gone if you had a 75 to 80% loan to value loan. So, just trying to navigate, with a lot of our clients that needed more leverage at the time, just whether you have to do a cash and refinance or, potentially sell the property. And I think you're seeing that, as we approach the middle part of the year, when people start having liquidity problems on some of these bridge loans where you were, a lot of those people did not take out caps at all. So you could have, LIBOR or SOFR plus 450. So pretty quickly you could be at 8-9%. So I think people can float that for a period of time, but at some point they're going to have to transact.
Yep. And another thing we've seen too at the agencies is for high mission deals, we're getting some 35-year amortizations.
Yeah, and they're going to continue that. I know they talked about pulling that back. at the end of the year, but they're going to continue that on in 2023, which is great, I think, for the industry and for them to capture more lower leverage business.
Yeah, we had a call with Freddie Mac call yesterday, and they were saying it's been a slow start to their year because of rates and everything going up, and that's one of their solves for it, is to do a longer amortization. So we've talked about everything that's bad. Rates are up, banks want the money back. Why are things okay?
I can jump in. I'll jump in.
Thanks, Brett.
Yeah, I'm still pretty optimistic on 2023, looking forward. There's a ton of liquidity. This is not a liquidity issue. Every life insurance company that we've spoke with, and we'll have our mortgage bankers conference here in February, they all have increased allocations, over their 2022. They want to put money out. Fannie and Freddie are mandated to put money out to provide liquidity to the marketplace. I think we have found some stability. Hopefully that maintains with the 10-year treasury back down to 3.5. On the life company side, spreads, for kind of a high quality asset, high quality borrower, potentially in the 155 to 160 at probably 55 to 60% leverage. We are getting close to that 5% coupon again on kind of those Class A lower leverage deals. Fannie and Freddie, from the investor side buying that paper, there's still a strong demand for that paper. So I think investor spreads have stayed pretty stable, really, even through the turbulence. Fannie and Freddie spreads have kind of always been in that 170 to 200 to 210. And again, today, if you've got a mission deal, which is where Fannie and Freddie are going to price the most competitive, and that's affordable housing, workforce housing, kind of think Class B type assets, you can get a 160, a 170 spread, which is still probably 65% loan to value, but you can get 5 to 7, maybe even 10 years of interest only, and that coupon is 5.5%. So it wasn't that long ago rates were where they are today, or getting close to. I mean, 2018 we did a lot of business at 5 to 5.25. So we talk a lot about cap rates and how they lag, and it sounds like things are starting to loosen up, and once we have price discovery, and I think the transaction volume is going to pick up if we can kind of keep rates here in the 5 to 5.5 range.
I'd say generally Minneapolis is a mission-rich market for the agencies. A lot of the properties will qualify for that lower pricing, and on some of the lower leverage stuff we've done, we've gotten some quotes back with a 4 in the front. It's challenging, but depending where that treasury bounces up and down, if you catch it right, you could be in the high 4s.
I was just going to say, as it relates to, again, equity investors, and I'll give you some real life example. Over the last 5 years, we've got some commercial property. Take one of our office buildings, 100% leased, institutional quality credit, throwing off 10+% cash yields versus a standard apartment project that's maybe throwing off 8%. And so for years, like, well, wow, this office building is outperforming your apartment buildings. But guess what? There's not a CEO in America right now, or in the world, as you're looking at office renewals, that thinks that they need the same amount of space that they did previously. So we're getting calls, hey, we want to renew for 10 years, but we don't need 100,000 feet anymore. We only need 50. COVID's proven we can work from home. And so you've got a huge risk factor in other real estate asset classes. So kind of back to where the capital wants to go. If you're an investor and you're looking at that, where would you want to put your money right now? And then again, I look at back for a long-term perspective, this is still a great sector of the real estate investment platform to put your money into. So why are we okay? Again, I think that there is capital out there at the right time that's going to come back into this space.
Yeah, I'd echo that. I mean, I think if I remember the last big 08, 09 recession, it felt like there was a lot more unsolvable problems. It feels like today the problems that we're talking about are solvable problems, and that the markets were more disciplined leading up to where we're at today than they had been in sort of economic cycles of the past. So that gives me comfort that if we look at our portfolio and transactions that we either have maturing or repricing, or ones that we feel like are a bit tight, these feel like they're solvable problems, and things that with prudent management and good oversight can be worked through without too much of an issue.
Yeah, I feel like, and you hear the panel before, I mean, I think the apartment fundamentals are pretty strong, and the issues in the market today are more just capital markets driven. But if you like we talked about earlier, having longer term debt ride out the storm, I still think the apartment market, especially in the upper Midwest, is going to continue to perform really well over the next 5 to 10 years.
I mean, vacancy rates certainly are going up in apartments, so as an operator side, you never like to see that, but vacancy rates were almost zero. So when you look at it even historically, I mean, Twin Cities, yeah, certainly we've got supply and demand happening, but vacancy rates may be at 6%, but and you feel like, oh crap, vacancy rates are 6%. That's not a big deal, right? Unless you underwrote at 2% vacancy, maybe then it is a big deal. But it's still historically strong occupancy in apartments, and I don't think that's changing anytime soon. So certainly a positive there. I mean, inflation numbers just came out, 6.5%. Interest rates are really priced in already. So I don't see interest rates probably going up too much. It depends on what the Fed does, obviously, too. But I don't think that's going to happen too much. I just read an article, I think it was put out by UBS, that they expect inflation at the end of the year to be 2.1%, and they expect that rates will come down in July. Obviously that's predictions, so we'll see what happens, but positives there as well if that happens.
So as an owner, if you got your debt fixed, what have been the other challenges on operating and the bottom line?
Yeah, well, I think that's, as an owner, if you got your debt fixed, you're obviously now you're just worried about your income and expenses. So it's just keeping I would say probably the biggest pain for us has been on the collection side, and depending on what city we're in, so in Minnesota, for instance, it's been challenging to evict tenants that aren't paying rent. It's still challenging in this state, in the metro. It's still challenging. You can do it, but it takes a lot more work. We have properties in Tennessee, and it's like, hey, they didn't pay rent. All right, they're gone. Like it's not a big deal. So state by state, but it doesn't matter what state we're in. We're still seeing our actual economic occupancy is worse than it was pre-pandemic. I feel like across the board, that's the case. And so we're trying to be a lot more picky on the residents that we do bring into our properties, trying to just be a lot more diligent on that end. A little bit larger security deposits, and then just really minding our expenses. As the last panel talked, some things we can't even control. Property taxes have skyrocketed. Insurance has skyrocketed. So what can we do though to mitigate that potentially, and what can we do to control the rest of our expenses?
From the bank's perspective, when you're looking at development deals, how are you looking at expenses now versus 3 years ago?
Yeah, well, I mean, all the issues at the prior panel and that we've just discussed related to sort of operational stuff, we're thinking about that as well. We're relying on our own internal evaluation in our portfolio of how we see our portfolio operate. We're relying on our borrowers' sort of insights into that specific project. We rely on our appraisers to have additional market intel to show us, where we feel like these properties can realistically operate. We certainly stress those projections to make sure that we're giving ourselves additional cushion. We've always done that. I think the variability that we've seen in some of those line items has been more than what any of us would have expected. So I think we are being a bit more prudent as we look at development deals. and say, well, does this feel right given what we know has happened? And in some cases, you don't know where it's going to come from, right? So everyone's been playing whack-a-mole on these development projects, and from a problem-solving perspective, it's been, everything from underwriting taxes to dealing with lumber costs to supply chain issues and interest rates and rent control. And I mean, so it seems like we've got transactions that we've been working on with our customers for I used to be months, but so now it's like we're on year 2 of working on a transaction with them, because as you solve a problem, a new problem has come up. And if you think about just over the last 12 months, not only have you been solving problems, but in the meantime, your interest rate problem just continue to get more and more difficult. So that's just made these deals just really hard to pencil in general, and which is why I think, like as Matt mentioned on the prior panel, a lot of stuff has been put on hold. What we've seen is transactions that were on the if you're on the 5-yard line, looking at a touchdown, I mean, you're finding ways to get those deals pushed over the finish line. If you're on your own 20, your people are punting, and they're just saying, hey, we're going to wait and we'll look at this deal later. Maybe the seller, there's probably not another buyer behind me. I used to feel like I had to, have sharp elbows and muscle out the other developers, but I probably don't need to do that so much anymore. The hard deals are the ones where, you're on the 50 or you're on the opponent's 40 and you've got sunk pre-development costs. Maybe you bought the land. I mean, if you've got $3-4 million into a development deal, but you're not closing tomorrow, I mean, those are hard. And those are the ones where we've seen sort of the most change in sort of the capital stack over the last 12 months. We talked about it on our call. We just re-underwrote a transaction we've been working on for quite a while, local development project. As we sized out to an underwritten NOI and through our debt sizing rate at it and a debt coverage ratio, we were sizing that transaction out to just a hair under 50% loan to cost. So if you're a developer, you either need to have a mountain of capital or you need to get creative, which is what a lot of folks are doing. They're trying to say, hey, I can't put 50% loan, or equity dollars into a deal and get a return that makes sense. So how can I plug these holes? And they're going back to the land seller. They're getting, public subsidy through TIF or grants or other items. They're trying to get creative to solve those problems, which is what's necessary, because if we think about a takeout interest rate that's higher than, we used to be able to underwrite to let's be conservative and assume the rate's 4.5% on the takeout, So, those sorts of days are gone. So we have to be conservative when we're thinking about what the takeout rate could be. And in those situations, you have to get creative on figuring it out. Like I said, the difficulty is everyone's been playing whack-a-mole. So, I mean, we mentioned equilibrium and stability to the extent that sort of whatever the environment looks like today can remain status quo for a while. That will allow folks to solve the problems. I'm a big believer in the resourcefulness of the American entrepreneur. So I believe that we can solve these problems. It's just the fact that you have to keep solving new problems. It just makes things really hard to do.
Yeah, well, we're in a negative, like to your point, like bringing 50%. I mean, that actually, we're in a negative leverage environment right now, right? Yeah. So meaning your cap rates are lower than your interest rate is. So the more money you borrow, your returns are going down.
Right. So
bringing cash to the table is actually your best return at this point in time. Now, I'm not saying that's what you should do because there's the business case to bring in the leverage, but it's just.
Well, and that's like why I said that none of these deals are loan to value constrained, especially on the development side. But then, for investors are trying to figure out, well, what premium do I need to get on a speculative multifamily development versus a risk-free rate of return, right? So as we saw treasuries, 10-year treasury get up to, almost 4.5%, there's a lot of smarter developers in here that know what the premium needs to be. I don't know what that needs to be, but it certainly needs to be something higher than 4.5% to be able to justify to your investor that you're returning a better return than what a risk-free rate could be.
Yeah, I'd add, the 3 or 4 development loans that we executed last year. I think every project had a TIF or some sort of tax abatement that made those deals go. The floating rate construction debt is extremely challenging to model out today, whether that's simply the rate or the interest reserve calculation. So that's pushing leverage. Where we have found success is still finding some banks that maybe didn't put out as much money in the first half of 2022 and wanted to end the year strong. So still was able to locate some, fixed rate construction debt. So at least you can put that component to bed up front, but every deal had some sort of TIF or tax abatement to make it work last year.
Andy is the guy on the panel with probably the most gray hair. You've been through this a couple times.
I didn't think I had any.
How does this compare to cycles in the past?
I've been doing this a long time. I'd say this one happened, and we've all said this happened quicker and stronger than any of us expected. I think there's not a person in this room that didn't expect rates to go up, but we certainly didn't expect them to go up so dramatically, so fast. So that's what's really taken everybody by storm. And I think that's frankly what's happening right now. If the Fed's getting what they want, things are screeching to a halt. It's probably a welcome reset. I know it's not fun to go through, but every once in a while you do need to take a pause and reset. And so I think this ultimately is good for the industry. For the young people in the room, it's always, we were drunk with low rates here for the last several years. So it's always good when you see pain early in your career, you learn from those things. So, I got in this business in the late 80s and saw the S&L crisis within a couple of years. So it was a good thing because it just brings discipline to the system. But again, I think that there will be opportunity with this. I think there'll be some pain along the way. It was interesting for the last couple of years, at least from our perspective, it's hard to buy things in the market for our model because the cap rates got so low in the space. So we actually kind of redirected our money more to the development side because we like the unleveraged return on cost kind of calculus. Say make it up 6% versus buying something in a 4.5. So you got that extra yield. Well, I think that's going to flip now because development's so difficult. So for the time being, I think that at some point when the market does reset, there'll be opportunities again, trying to buy some things that maybe have been price dislocated. There's probably, again, a lot of people in the room pick up a development model over the last few years, call it a $30 million apartment development, 20 million of debt and 10 million of equity. And the underwriting was, hey, we're going to build it, stabilize it, and we're going to call Fritz and refinance the 10 million with 15 million and return half the, return the investor half the investor's equity, and all it's going to be good. Well, guess what? That's not going to happen. So at best you might be able to just refinance at par, maybe pull out a little bit, but there's going to be situations where you're actually not only you're not going to be able to pull out some of that equity, you're actually going to have to infuse it with more. And not everyone's going to be able to do that or want to do that. And so I think there'll be situations where if you can't do it, or if you finally say, you know what, all right, I didn't get the 20 IR that I thought I was going to get, but 12 still good, and I'll sell it at that, and that's still good enough, and I'll recirculate the capital. And once that happens is when you'll start to see some of this dislocation in the market resetting. But when that is everybody's guess. I think it'll happen in the next 6 to 9 months, or at least to some extent will. So that's, at least in our shop, that's what we're preparing for.
We got Fritz and Brett and Todd up here. You guys do business cross country, Andy as well. How does Minneapolis, our area, compare to other markets, and what's challenging here versus others, or vice versa?
I guess I can kick it off. I guess, and the previous panel mentioned as well, but the rent growth here over the last couple of years just has not been the same as in some other markets. And so I think because of that, you're not going to have the same issues that the Phoenixes, the Denvers, and the Dallases are going to have over the next 12 years. So I think the Minneapolis market is set to outperform over the next 3 to 5 years in some of the Sun Belt markets as they continue to recover from, I was talking to a client last week, and over the last year, they were getting 20 to 30% rent growth for doing nothing in the Sun Belt. So valuations took off, and now they're coming back to reality. When you go from a 3 cap to a 5 or 6 cap, it's going to be pretty painful for some people. But in the Twin Cities, you just didn't have that, and it's going to be slow and steady. And over time, I still think it's a great place to own and operate apartments for the long run.
Yeah, and I do a lot of business down in Iowa, in South Dakota, and little smaller market, secondary market. Don't get the high highs, don't get the low lows. So fundamentally, still strong in a lot of those markets. Have seen buyers from the Twin Cities and across some of the other major markets start to focus and try to get some assets in these markets, just because there was still some yield available. So still seeing some pretty good rent growth, I would say, in some of the secondary or tertiary markets that maybe didn't see the supply that the Twin Cities or other higher growth markets had. So just going back, I think fundamentals are strong, both capital on the lender side and equity side have kind of opened up into some of these secondary markets. So again, it's not a liquidity issue. So we've just seen borrowers say, if I can get the same debt essentially at 5.5%, but now I can buy an asset at a 5.5 cap instead of a 4.5 cap. We've seen kind of an influx of capital into those markets. So the other space I play in is student housing. And obviously COVID had a big impact on student housing, but we have seen a tremendous amount of activity still in the student housing space. That space has come out of COVID very strong. Lenders are focused again on kind of the major schools. Proximity to campus remains one of the most important things on the student side. I'd say most lenders want to be a mile to 2 miles from campus, and but students came back as everybody knew they would, and we're seeing occupancies in the on a lot of projects we're looking at in the 96 to 98%. So that's what I kind of do more on a national basis, but I think fundamentals just remain strong across the board.
Yeah, I think you can paint either a negative picture or positive picture of the Twin Cities. I think you can take some of the statistics and go, this is actually a good thing, or you can take some of those statistics and go, wow, this is really bad. For instance, like since March of 2020, Minneapolis is the 3rd worst rent growth market in the entire country, right? Of the major markets. And that's behind San Francisco and San Jose they had rent decline. But then Minneapolis had a positive 3%. And you could say that's negative. Or you could say, well, that's a good thing because our rent affordability is still intact, right? We ranked 89 out of 100 of the top 100 markets. We're 89th as far as how much we charge our residents for rent. So they can still afford to live here. So you could say, well, that's a good thing. We didn't skyrocket like some of these other cities. Seattle and Washington are tied for number 4 on the list at 8% rent growth. We only had 3%. So that's a negative and it's a positive, right? I think you could take and say both of it. One of the negatives, one of the reasons why we're not super high on the Twin Cities is because of the political environment. Minneapolis and St. Paul in particular, they hate us, right? They hate landlords. They just do. They hate landlords. I think if they could rid us all, they would. The suburbs are doing good. If you look at the rent growth in the suburbs, Minneapolis year over year, 0.4%. If you look at the suburbs, Apple Valley, 3.4%, Bloomington, 8.9%. Egan, 4.5%. Interestingly enough, Woodbury only at 0.2%, but that's just because they had a lot of development there. But, suburbs, I think, are going to probably remain strong for the foreseeable future. Minneapolis and St. Paul, I think, are big question marks moving forward. What's going to happen with rent growth? How crazy are they going to get with all these things they love to put in place? And how are investors going to react, and how is it going to, I think we all know the negatives of rent restrictions so what's going to happen there? What's the city going to look like? So I'd say overall, you know, we're still that slow, steady growth market. So it's a good thing in this environment. And I think there's going to be some deals that people can get. People that maybe thought Minneapolis and St. Paul, or the Twin Cities, were going to be that Sun Belt type growth market. So that's how they underwrote it. And now they're realizing that it's not, and they might have to get out of a deal. So I think there's going to be some opportunity for smart, savvy investors to get into.
Nick, you see every deal that comes through Bridgewater. What have you seen with rent control? Just anecdotally, the numbers of deals in Minneapolis and St. Paul now compared to 5 years ago?
Yeah, I mean,
Development.
and we only see the stuff that everybody else has already passed on, right? So I think to the extent that every pro forma that lands on our desk works, whether it works or not. But you know, I don't have specific data, but I mean, anecdotally, you know, our activity has followed what all the developers have done. I mean, folks have pushed out of Minneapolis and St. Paul just because you know, it's harder to underwrite those rental income streams over the long term for us as a lender. So we're gonna be a bit more critical on underwriting that income stream over the long term, as do you know, the investors that are putting their capital into these transactions. So I don't have specific data on it, but I mean, anecdotally, I mean, most of our development activity as of late has been in, you know, suburban markets and out of Minneapolis and St. Paul core. I should say, with the exception of sort of, you know, pocket tuck-in deals that are, you know, 20, 30 units. Those are just less impacted in general.
5 minutes. Where do you see the biggest opportunities in this year? And at what point in the year? Brett?
Sure. Well, on the debt side, I just think it's, you know, finding stability and getting transaction volume back, which again, I'm optimistic that we are starting to get there. From a borrower's perspective, you know, Fannie and Freddie have $70 billion to lend in 2023 each. They're going to be in the market. They can provide anything from floating rate debt, you know, to 5, 7, 10, 12, 15-year fixed rate debt. There's going to be liquidity and good debt with, as I mentioned earlier, a good amount of interest only if you're interested in that. So I think the opportunity is just going to be, you know, if you have the ability to wait, you probably want to wait until the second half of 2023 to execute, but there's going to be a lot of capital.
Yeah, I'll maybe piggyback off that, and I'll start negative and then positive. I'm a believer. I think that rates will come down, you know, toward the back part of this year. You know, but that being said, I think the thing I try to remind my folks about is, if the Fed does pivot and they decide to start cutting rates, well, they don't just do that so that everybody's development projects work, right? I mean, they do that because there's economic pain being felt, and they feel like they need to stimulate the economy. So if rates are down, that could mean that your rents are down, or your building has more vacancy because there's less household formation because people are doubling up or they're moving back in because they lost their job. So I don't look at rates coming down as our sort of savior here. You know, and the thing to remember is that rates are always moving one way or the other. You know, and relatively speaking, they're not consistent for a very long period of time. So rates they're a little higher, then they're a little lower, then they're flat for a bit, then they're higher again. So I think that there is opportunity in this economic environment where, you know, cap rates, if they, you know, we know they have increased, if they do continue to increase, you know, that provides, as a long-term owner, the opportunity to buy an asset at a price that you can make work long-term. And your debt, you know, to Brett's point about folks pivoting from doing a Fannie Mae execution that has a big yield maintenance penalty on it, to doing it with your friendly local neighborhood banker, you know, that can provide some more interest rate, you know, refinance flexibility down the road. You can buy at a good price and then ultimately refinance, right? So, you know, it's the whole, you know, money is made in these economic downturns, and it's realized in the positive times. So to the extent that you can look at these and have some capital on the sidelines to be able to get, get some projects, under your belt. And if you're a developer, if you can get your deal done, I mean, you're not delivering in today's environment, you're delivering into an environment, 12, 18, 24 months from now. So, perhaps you're on the other side of that potential downturn that's been forecasted. So, if you can get your deal done, you have opportunity to be sort of one of a few that have a deal delivering into what could be, the better side of an environment.
Yeah, everything I'm going to say is obviously it's predicated on like how deep of a recession are we going to have, if we're going to have a recession, all that. We just don't know. So we're trying to predict in the future, obviously. But I think there's a lot of loans that were written that were higher risk loans over the last several years. It was mentioned 75% of the loans are all of a sudden bridge loans. And so there's a lot of loans. I think it's nearly $1 trillion worth of loans that are coming on maturity by 2024. So a lot of these loans, many of them are going to be fine, but there's plenty of them that aren't. And what I see as an opportunity is being able to come in with equity. And so that loan that comes to maturity, they may be leveraged at a really high bridge loan, and you're going to need to come to the table with an extra $2, $3, $5, $10 million in order to get that into a long-term loan. And so I think as a company, if you can figure out how to bring the money into a deal, you're going to be able to buy out the general partner, potentially the limited partners, or at least lower the limited partners' interest or shares, and bring in fresh new money and get into some deals at a pretty low basis compared to where you were able to get in several years ago. So I think replacing equity versus just maybe we'll see a lot of foreclosures. I don't see that happening. I don't think that's going to be the case. I think it's going to be coming in and replacing equity. That's going to be the best opportunity, in my opinion. Again, I probably have about a 25% chance of being right on it, but that's what I feel.
The one thing we really haven't talked about, maybe it will be on a later panel, but just costs, material costs, labor costs, everything else is the big question. Is it going to continue to go up? Is it going to stabilize? Is it going to come down? We debate that every day, to be seen. You still have China locked down. You still have a lot of backlog with subs and everything else. So I'm of the belief that once you get some stability in that and the projects in the current queue finish off and the forward-looking pipeline looks a little bit thinner, that you're going to start to see some easing of that. I think there's also been a lot of fluff in a lot of these. It's been so volatile given COVID and everything else that everything's padded because it has to be, because there's just so much risk in there. So that's the other question, is if and when you'll start to see that start to ease. And again, I think it's, we've got a little bit of time here to settle in and reset and focus on what we have. And so for opportunity for me, I'm trying to figure out how I get my backswing up just a little bit closer to parallel so I can hit the ball a little bit further and get rid of my jabby putter style. And this perfect opportunity this spring and summer to do that.
For me, I think, and we've started to see it at our firm the last quarter, is loan assumptions. And I think Ted Bickel brought it up earlier. Because if you're able to, there was plenty of fixed rate debt that was done over the last 2 or 3 years at, sub 4%. So if you're able to have 5 to 7 years remaining on that term, maybe a little bit of a couple years of interest only remaining kind of gets you to the other side without having to go out, 7 to 10 years with yield maintenance. So I've seen, our firm's probably 50 to 100% more than assumption requests than we've seen in previous years, just because there's a lot of cheap debt that's able to get assumed. And I feel like that's, like as Ted mentioned earlier, the bid-ask spread is a lot tighter on those loan assumptions, just given the fact that you're able to borrow at 3 or 4%.
Yeah, on the construction side, shipping costs are going down, or will be going down. They're already going down, but they're going to continue to go down. And labor potentially can free up a lot. I know of several very sizable companies that have laid off 20 to 30% of their labor force. These are construction companies. So the foundations, the framers, those are what's going to go first. So they're laying people off. And so I don't necessarily think construction costs are going to plummet and get crushed, but I think you might see a little bit of freeing up of some of those expenses as well.
All right, I think that's our time. Appreciate it. We'll carry this on at the lobby bar on Bridgewater's Capital.
Yes.
All right, they're ready to go. So moderating this panel is Cecil Smith. He's the president and CEO of the Minnesota Multi-Housing Association. So please welcome Cecil and his panel.
So if folks hadn't noticed, we're about to bring a little bit of gender balance to this program today. I'm going to call a quick audible here because I've been in the audience listening with you, and one of the things that I haven't heard yet talked about, which in terms of the environment that we're operating in is a major factor, is that we just saw a major change at the state legislature. And nobody has yet talked about the trifecta and what that might mean for housing policy in Minnesota and how that's going to change. So MHA is at the Capitol every day with our team. I was there last night testifying, and we're tracking over 40 bills that are coming through. And with the trifecta, we're going to see a major change that the legislature has not been a part of the housing discussion in a very large manner for a long time because of divided government. And we've been one of the few states, and certainly in the last cycle, we were the only state with a divided legislature. And that meant there was a lot of moderation on state housing policy. That is about to change. We're about to see change in eviction policy with automatic expungements, potentially taking up to 60 days through the court process. These are all things that are planned and are part of the governor's agenda. We're going to see source of income protections, very likely, which would mean mandatory acceptance of Section 8. These are all things that are going to change in state policy. We haven't had that conversation yet this morning. I just wanted to mention that, to put that on everybody's radar screen, and to make sure you're tracking things at the Capitol, because it is a different environment. And even though the Senate and the House are tightly divided, there is pent-up demand to see major change in state housing policy. There might be some good things like large-scale investment in rental assistance or income support to cost-burdened household, which might help many of us with collection issues. But there's also going to be a lot more regulation, unfortunately. We're going to be working hard to make sure it's the best it can be and what's only necessary, but that is something that needs to be watched. So with that, let me introduce our esteemed panel here. They're going to introduce themselves, but Sydney, Heather, Jamie, Erin, and Alex have joined us to talk about operations and what's happening on the front line. So Sydney, why don't you start?
Awesome, thank you. Can everyone hear me? No. Is on? Looks on. What about now? Yeah. Yep, okay, cool. On button, who would have thought? I'm Sydney Anderson. I'm the Senior Director of Client Services for Greystar. We are the largest multifamily manager in the world currently. We have around 10,000 units in Minnesota. Around 8,400 of those are conventional multifamily housing, which is what falls under my purview. And if you're wondering if we bullied Alex into sitting at his own table and made this a girls-only party, the answer is yes.
Hi there, my name is Heather Fleetum. I work for Lincoln Property Company. We have about 200,000 or so nationwide units and 5,600 here locally that I oversee.
Can you hear me? Good morning. I'm Jamie Perrin with Saturday Properties. We're a local developer and management company, so we're a small operator. We manage about 1,500 units. 90% of what we manage is in Minneapolis and St. Paul.
Good morning, Erin Franzen with Timberland Partners. We own and manage about 20,000 units across 17 states, 3,000 of those being in Minnesota.
Good morning, my name's Alex Salchuk, and I operate Lelch Audio Visual. We're a technology integrator that has a specialty niche in the multifamily space.
So we heard, thanks everybody, we heard Matt Mullins earlier talk about modest vacancy challenges, except perhaps in the CBD, strong absorption. So what are you seeing in your portfolios with regard to vacancy or occupancy? And if you have new product, how is your lease up going and what concessions are you offering where and how much?
I can jump in. Vacancy has been very low. I mean, we're seeing kind of the trends that everybody has been seeing across this market, across the nation. But we feel some softness coming. While our vacancy hasn't really dipped yet, something that we track very closely is asking rent. So asking rents throughout 2021 always increased. And in 2022, kind of late summer, we saw asking rents start to come down. Those have now stabilized, but they're down about 5-6%. So that's gonna possibly translate into some vacancy challenges. In terms of absorption, we have one property right now that we're in the lease up, Paravel in Eden Prairie, a luxury property. So we've leased 7 units so far. That should open this summer. But we're not too concerned about it now, thinking about the seasonality, spring will be stronger there. But our most expensive units are what are going first. So kind of thankful that the product that we have out there is that luxury product that we still see strong demand for.
Awesome. I can chat a little bit about occupancy, concessions, absorption also. So just like everyone said, occupancy has actually been really strong, not really a concern for us, urban or suburban. We do have active lease ups. Probably the best and most relevant example is 270 Hennepin down on Hennepin. Going into that lease up, we were pretty concerned. Its 3 major comps had vacancy of around 21%. We've seen those comps come down to an average of 8.8%, which is really great for our micro location there. And we've actually been absorbing, including the past few months, which we all know are basically dead weight in Minnesota, around 20 units a month. If you cut those out, because in my mind they don't count, you just get so little traction, right about 24 units a month. And that's at, market, highest market rents really in the CBD. So we're really happy with that. But it really depends on where you're located. There's a different story going on over by Uptown, which I'm sure Jamie can get into a little bit, right? We don't see as strong of occupancies. And likewise, we don't see as strong of absorption. We're at about half of what we're seeing downtown on Hennepin, which with all of the negative headlines around activity downtown, it's surprising to see that, but it is something we're experiencing. We're probably going to get more into occupancy, but I'll just throw this out there. Suburban's really strong, but so are our urban neighborhoods. In our North Loop portfolio, 6 out of 7 of our properties are between 95 and 97.5%. You really can't ask for more.
Well, I can talk about Uptown. So obviously there's been some volatility in that submarket. But I think occupancy is stabilized now. I think the name of the game there is rent growth. So we did start to see our rents kind of climb back up. And when I say rent, I mean effective rent. So we're talking about including concessions. And I think it remains it's a concession market in Minneapolis. And so I think that's the struggle. I think year over year, lease over lease, we're looking at about a 4% increase. We still haven't gotten to our pre-pandemic rents yet, but it's encouraging. I think having the occupancy and the volatility has slowed down in Uptown. We also have 250 units in South Minneapolis, very close to Lake and Hiawatha, one we're finishing out the lease up on, and that's been a challenge as well, just the concessions and the safety concerns. But I think closing in on some really strong occupancy there as well. So I think St. Paul for us has been a little bit more of a challenge. So we have 3 projects in St. Paul that we're closing in on 85% occupancy, but it's been a little bit slower than we would have liked to have seen. So a little bit soft on rents, but it's encouraging. Leasing activity has been strong.
Do you want to comment on those particular submarkets or micro markets, what the headwinds are, what you think are happening there that differentiate it from other stronger markets?
Yeah, I can talk just a little bit about why I think the North Loop has done so well. In my eyes, and this is a personal opinion, the North Loop is really the only neighborhood in urban Minneapolis where you can live, work, play, right? You can walk to city center, you can walk to the Skyway, you're a really quick commute if you have to hop on any of the interstate systems. And so it's kind of been, if you couldn't have your office, you still had your working or your play and your nightlife. Whereas if you look at Uptown, it's never been a super strong office market. You could really only live and play. So I think that's one of the reasons the North Loop has just performed so well for us, despite experiencing the things we've experienced elsewhere, like in Uptown. There is an increase in crime. I pulled my manager's opinions on, hey, what are things that are new that you're dealing with and we feel like they came out of the pandemic or out of the civil unrest? And predominantly they said crime. We never had this amount of break-ins. We never had this amount of security concerns. So I think that remains a real headwind, especially in downtown St. Paul. As Jamie mentioned, we had a lease up in downtown St. Paul. It did really well. Pandemic hit, civil unrest hit, and it's been a struggle since. That's post being stabilized. Whereas we had a property on Shepherd's Parkway, a little bit out of the city, out of the, kind of the crime concern area, and it leased up faster than any lease up we've done in the past 5 years. It's doing exceptionally well because people feel safer there. So I think safety is probably our primary headwind. Downtown, I think it's also supply.
Yeah, I can piggyback on Minneapolis, and as far as the safety concerns go, one of the other challenges we have is we need live bodies and security, not just cameras and changing fob access and different things of that nature. And it's actually difficult to find security companies that have quality security guards that can work in your building and partner with you. So that's been a challenge. I know some of our buildings are paying $6,000 a month in security guard expenses. So that's been a challenge. And I would say, going back to the topic of concessions, some of our urban sites, they're not lease ups, but they feel like lease ups. During the pandemic, rents were lowered, concessions were increased, and we got a completely different demographic into the building that wasn't our target demographic, that ultimately can't afford that rent or to live that lifestyle. And so now, as we're taking away the concessions, increasing the rents, we're actually also turning over, those folks in the building that, tried it on for size during the pandemic because of the lower rent. And now we need to, utilize our marketing strategies to get in those people back that can actually afford that rent.
Anything else? Well, I want to follow up with you, Heather, because we know that you have some BTR, SFR, build to rent, single family rentals. And we're curious about that product subcategory in Minnesota, especially now post-pandemic. So tell us how that's going, and I think some of our other panelists might have some questions too for you.
Yeah, absolutely. BTR has never made me more popular. In Minnesota, we have about 9 communities here. We have a couple thousand throughout, Lincoln as a whole nationally. But the 9 communities we have here, 2 of them are stabilized. Those are going well. Steady Eddies, like we've referenced before. The others are in various stages of lease up. So they're either coming out of the ground or they're finishing coming out of the ground. I think one thing that some people don't realize about BTR is you don't get 80 units that you're renting, you get 2, and then you get 4. And we're really at the mercy of the construction crews to complete those on time so we can actually rent them. We can't start marketing that unit for rent until the construction crew gives us that lock date and when they're delivering that unit to us. So a lot of times we have, a 2-week window that we're gonna start marketing that. So the touch points with those residents, or those candidates, I should say, is a long period of time. We're keeping them warm. There could be 6 tours from the time that they express interest to the time the home comes available that they're looking to rent. Another behavior of the single family home applicant is a lot of people in between homes. So they're selling or they're downsizing or they're building and they need that home in between. Well, with the housing market, that's actually subsided. So we're not seeing as much of that traffic visiting our communities that need that temporary solution, which is actually okay in the long run. We have better retention rates than the turnover costs decrease, but we do miss out on some of that shot in the arm occupancy and some of those short-term fees that we see from those folks.
So are they easier lease-ups?
They're just different. I wouldn't say they're easier. I think, you know, instead of all hands on deck, fill up a building and then stabilize, you're kind of held hostage in lease-up mode. So you're constantly pivoting, you're constantly rethinking things, you know. It's just different, but it's fun, and I think it allows us to be creative in a different way, just because it's not the same candidate that you see in your tower or your mid-rise. So it just allows us to be creative and do things a little bit differently.
How are you staffing during those periods when you might only have, you know, 10 units rented? Do you have a full-time community manager, or are you man and abandoning it?
That's a great question. You know, a lot of the models, when we go into them, the expenses are written very low, and payroll is part of that. So a lot of it depends on what the owner demands are. So some of our clients are okay with shared staffing to keep that number low. So we might have a manager or leasing folks that serve several communities, where we have some clients who say, no, I want this person dedicated, I want them focused, and I want them to fill up this building. So it's a little bit depends on who the client is and what they want that to look like.
Have you had much turnover, and what, you know, turnover expenses in much smaller units are up so significantly? So is that a challenge? How do you manage that?
Yeah, turnover is really high. These are larger square footages. You know, single family home residents really move in. They hang stuff on the walls. They, you know, it's a full paint. And I think painting is definitely the highest cost that we've seen increase. It can be $1,300 to paint a home in between people. So ideally, we're getting those longer term residents that are going to stick around, so we can, you know, get a bigger gap in between when we're turning over those units.
Well, I'm sure everybody's going to continue to pay close attention to BTR. So let me turn now to talking about renters. So at MHA, we used to have the tagline, rent your home, own your life, to try and develop this idea in Minnesota of lifestyle renters. And that really has come to fruition. So can our panel tell us about other changes, good and bad, that you're seeing in the applicant pool and the characteristics of your successful customers? And what do these great renters want from their apartment homes? You want to start, Jamie?
Sure. I think what we've seen, particularly in the urban markets, one of the challenges we actually face is that we thought micro units were going to take off. And what we've seen since the pandemic is people are looking for space. And so I think when we're thinking about new deals, new developments, and we're reimagining spaces within our buildings, it really is communal space, active communal space that is practical. So I think that's been something that's changed for us. As far as renters go, I think we all discussed this on our call, just some of the challenges that we face. It takes longer to find the right renter. I think it was mentioned on a previous panel, just the screening and making sure that we're not taking on someone that can't afford to live in our buildings. So that's just been a really interesting change for us particularly over the last 6 months. We've just seen a really big spike in fraud, ID fraud. So it's been an interesting challenge for us. So it takes a little bit longer. We were laughing about how you used to be able to rent to someone the same day. That just doesn't happen anymore.
You get like a yellow or a green light telling you they were approved. Yeah. It's awesome. I'm just going to speak a little bit on the fraud piece, because this is something that's actually been a real challenge for us everywhere in the United States. If you haven't come across it yet, you're going to. So I think it's good to be informed. But we've not only seen an increase in forged financial documents, but we've also seen an increase in synthetic identity fraud. So there are a couple of products, and I'm not being paid to plug them, but they've made a really big difference for us on our portfolio. One is Snapped, and the other one is Checkpoint ID. Snapped will help you identify if the financial documents being provided are fraudulent, and likewise, Checkpoint ID does the same thing for ID verification. So that has helped basically eliminate fraud where we have it in place, but it has definitely been a challenge. And once those folks move in, you have to basically follow the same process as a normal resident who's not paying rent to get them out of the building. So it's definitely something to watch out for. In terms of changes, we talked about this. Yes, we had a prep call. None of us wanted to come up here shooting from the hip, but we haven't seen any huge demographic shifts in our buildings. It's pretty much who was there pre-pandemic is still there today. But I think what we see is residents delaying big life decisions like purchasing a home or building a home because of, the rate environment, which is good for us. But we also see just a difference in how residents are using the buildings. So the things that are important to them now are maybe things they wouldn't have thought about back in 2018 or 2019. I'll give an example. We send out a design survey to our residents, and we ask them to rank in priority the features of their apartment and also assign a dollar value, a premium that they're willing to pay. And the number one highest priority item was additional soundproofing in a unit. That's not sexy, that's not fun at all, right? You would have thought like new stainless steel appliances, but no, they don't want to hear their neighbors and they want to be able to take calls from home without being interrupted or having background noise. So I think we just see a difference in their living priorities. We're also seeing more wear and tear on our buildings. So I think from a capital perspective, that's something that, we're encouraging our clients to be proactive about and have in mind. Like, carpet is wearing down faster. We've got conference rooms where the wheelie chairs are going back and forth so much that, we've had the carpet 2 years and it needs to be replaced. So it's more so how the buildings are being used by the same people.
So one of the, you kind of touched on what do great renters want? And for me, I kind of get back to the basics and security. We just have one property in St. Paul on the end of the light rail, one property in Minneapolis along the Green Line, and then a property in Eden Prairie where the light rail is gonna be someday. But that creates kind of these nodes for crime, and we've had a lot of issues there. And people wanna be in St. Paul, they wanna be in Minneapolis, but it's really hard. The crime is really hard, and specifically in Minneapolis, we partner with the local police there, but they're stretched really thin. And so we're having to kind of say, this is a tough property to manage. We need more security. Do we need 24/7 presence? What's the cost of that? And what does that do to kind of have the, to make the investment make sense? So just kind of getting back to basics. And it's not just Minneapolis. We have these issues across the country. But kind of specifically, just great renters want a safe place to live.
Yeah, I'd add to, as far as the residents in our buildings, they're home more. They used to be home 20% of the time, now they're home 80% of the time, and utilizing our site teams a lot more. They're utilizing our work pods and our conference rooms. They need the work from home environment. They need the technology to work. If they have a service request, we have to schedule an appointment with them because they're on a call or something along that line. Heaven forbid your coffee maker go out. Yes. So, the coffee, all of the things that they had in their work environment, we need to mimic in our communities, in those amenity spaces, and we're also now their coworkers. So now they're talking to us around the water cooler and things of that nature. So I think that has just added another layer of things that we need to be and support as far as our office teams go. And piggybacking on the security, and Alex can probably speak to it too, but one of the other things we've had to do is, move our Butterfly MX systems to the outside. We used to have, you walk in a door and you're standing in a warm space to call your friend that lives in the building, and now that needs to be on the outside of the door because we can't let anybody in that little precious vestibule space that's warm in the winter.
Yeah, Alex, do you want to comment on the security?
Yeah, I was just going to add to the security and all of the technology in the spaces are just becoming need to be of a higher quality and so people can really utilize them and have it be similar to what their experience is in the workspace for if they're at home more often working from there. And then from a security standpoint, we're definitely seeing an uptick in just more of it, right? Like more areas that are covered with cameras, more areas of access control where, sometimes the stairwells weren't a part of it, now they are. And just in general, the technology being thought about a little bit more, like the quality of the Wi-Fi, the quality of the experience as the resident is like flowing through the space. so that they're using, the same app to get into the building as they are to get into the amenity spaces, as they are to get into their unit, as they are to maybe manipulating the climate and the lights in their unit, and just having that be of a higher quality, and then also just how like all of that stacks with the rest of the software so that there's efficiency for management to facilitate all that and deal with the serviceability of it.
Great. Well, Heather, you started to allude to this with your comments about the interactions with the residents. This is a very difficult time to operate. It's inflation, labor shortages, interest rates are hitting our P&Ls, but so are resident expectations. Their expectations have changed over the last 2 or 3 years. How are you managing these challenges and continuing to provide great customer service? And specifically, let's talk about challenges in maintenance. And then Alex, maybe you want to weigh in on the vendor side with strategies that you're recommending to meet those residents' experience expectations.
Yeah, I had mentioned before, we need to make appointments with the residents to do those service requests because they're now home. If they need a part, it could be months till we get that fixed. So we're really relying on our maintenance teams to get really, really creative on, how we provide this service while our residents are waiting. It's communication, it's back to the basics, like Aaron said. We need resident events and we actually need to create that community. It makes them more forgiving on us when we're waiting for that part, or we're short-staffed, or our hours are shortened because we're missing a leasing consultant or something of that nature. I would say the multifamily industry as a whole is really impressive as far as our ability to be creative and pivot. And I think the pandemic was a perfect example of that. We were making hand sanitizer out of tequila. So, we had to get, we had to get really outside of the box. And, we basically pivoted in 48 hours and we're due virtual leasing and all those types of things. So I really don't think there's anything that we can't do or strategize, but finding the talent, keeping the talent, there's so much focus on resident retention and what can we do for the resident. And I think it's equally, if not more important, to be focusing on what we're doing for our team members. Once we attract the right talent, we really need to keep it there. Those are the folks that are coming up with the ideas for the hand sanitizer and those types of things, and we depend on them for that. So I think a really big focus needs to be on our team members. And the more they feel appreciated and engaged, then the more they're going to be creative and think out of the box and give you that extra effort to come up with these solutions on how to combat the delays in parts or services. Our vendors are also short-staffed. So if your snow plowing isn't going well, you can't fire them and get somebody else because nobody else is taking on new clients. So that's a problem. And we've even had our vendors recruit our team members. And so, that's been a struggle as well. So it just kind of goes back to just focusing on really appreciating our team members and the talent that we have.
And I'll add to that too. So at our company, I think our focus has always been employee first, which I realize might not always be popular with clients, but I think because we've stayed so focused on that, we have really low turnover, which we're really proud of, and really high employee satisfaction. And we've developed a reputation for that. So that helps with recruiting. But really our goal is to keep everyone, because there is such a shortage, like you were mentioning, in maintenance. You can't lose a good maintenance supervisor. You can't lose good maintenance folks because they're so hard to replace. So I think having a really strong training program, strong engagement programs are really important. So we stay really focused on employee engagement and employee retention, because happy employees will provide a great customer experience, which translates into dollars, right? People will stay. And so we have high resident satisfaction. And I think that all comes from the fact that we stay really focused on our employees. I think we can't talk enough though about the maintenance shortage. And like Heather alluded to, we have vendors taking our maintenance folks and starting their own maintenance companies. You know what I mean? Things like that are happening. So I think, whatever we can do to retain our
Don't do that, okay?
whatever we can do to retain our employees, I think is what we're focused. We have been focused on it, and I think it's really helped us. So our turnover last year was under 30%. So something that we stay focused on, I think really helps.
That's awesome. Our turnover was lower, it was not 30%, but just kind of echoing the same comments. In a time when all expenses are increasing, payroll is increasing significantly. We're looking at what really has to be done on site and what can maybe be centralized or specialized elsewhere. And that's not just leasing, that can be other areas, but maintenance cannot be done centrally. We have recently implemented a new kind of maintenance mobile technology, helping our maintenance teams be more efficient, but we still need the maintenance people doing the hard work, getting into the units, providing great customer service for all of our residents. Talking about appreciating employees. So over the Christmas break in the South, it was very cold, and we had a number of properties where pipes were breaking, major maintenance issues over Christmas Eve and Christmas Day. It was tough. So we're working with, okay, maybe we need to give them some more PTO. There were about 100 team members that our senior leaders, maybe 3 or 4 of our senior leaders, made phone calls to those people to just say thank you. It's Christmas and it's tough, and we could send them some money, but thank you for being there for your property, for your residents, and for each other.
Yeah, it goes a long way. I mean, one thing that we've tried to be conscientious of is, while we all got to work from home, our team members on site didn't. So they have been really in the trenches the past 2 years, and they're burnt out. One thing we've explored is doing some 4-day work weeks. Instead of having 5 days, 8 hours, 4 days, 10 hours, they get a long weekend, maybe they get a day off in the middle of the week, just to give some reprieve and get creative. Another thing that we are doing to be able to focus more on the resident on site, and this is really only being piloted on our Greystar owned platform. So if any of my clients are in the room, please don't get excited. We're in the very early stages, but we are centralizing the assistant manager position, essentially removing that role from on-site. We're calling it the resource center, and putting them in the office and giving them 4 to 5 properties. Helps alleviate some of that payroll burden we've seen creep up, and we've seen it creep up extensively. So in the Midwest, we've seen maintenance increase anywhere from 15 to 20% in payroll expectations over the past year. In office, team members 10 to 15%. So it's extremely significant when you consider that payroll is usually your highest or second highest expense category on a site. So 4-day work week, trying to centralize some positions so those who are on site can focus on resident satisfaction. Obviously being proactive with soliciting, feedback through Kingsley is also really helpful. It helps you, it's been around for years, but it does help you identify where your weak links are. And then using things like community rewards to get positive feedback, and it rewards the resident, or feedback of any kind, and it rewards the resident for that engagement, has been really helpful. More tool-based, but still something that is allowing for that interaction between resident and team members. I always say residents are super willing to leave a building. They're less willing to leave people that they like. And just being able to quantify that a little bit, I want to talk about rent growth. So we saw average renewal rent growth in Minnesota across our portfolio the past 12 months at 8%. I'm gonna be really honest with you, the suburbs were 14%. You can imagine the urban areas were negative, but 8% rent growth on renewal, whereas just actual rent growth was basically flat. So our best residents are our existing residents. They're also the cheapest lease we're gonna get. We don't have to offer them the same concessions that new leases are getting. So it's just so important to keep them happy. But to Heather, Jamie and Aaron's point, keeping our team members happy is where it starts.
And Alex, what recommendations do you have for the resident experience?
Yeah, so I think one of the things that we focus on for properties is to limit the amount of service that's required, right? In order to accomplish that, it's the planning that needs to go into it on the front end, and not overdoing it with technology in certain areas, not underdoing it, and just doing it in a way where it's kind of controlled and maintained. And so I think if that methodology is followed, as well as with some ongoing strategized maintenance, where there's maybe a visit a couple times throughout the year, the systems can sort of stay in place, and it takes the burden away from staff and property people from having to sort of manage that burden. As smart technologies are going into units and units are needing to turn over, selecting a smart apartment solution that does not require, somebody to manually do something. It can be done, as you're transitioning the person through the software.
So let's focus on leasing now. What's changed in that space? We saw a lot of pivoting during the pandemic and shifting back. Where is that right now? And what's the role of technology, and what place is that taken in leasing? And how are you staffing it? I'm interested to hear how the centralized resource person is assisting in that process, and what principles are guiding your current business practices around leasing.
So the person in the resource center would not be handling any, call center activity for setting up leasing appointments. I'm sure that's something we'll also look to in the future. And I know there are a number of regional players who do use a call center to set leasing appointments. I think it's a pretty great idea. I think something we can all relate to is a lot of the leasing solutions and technology that was really introduced pre-pandemic but took off and grew faster because of the pandemic doesn't really make our jobs any easier. You still need people to manage those systems, so you still need someone to send out a virtual tour link. You still need someone to check an application. So we really have not seen a body count reduction in sight in terms of the leasing team. I think the other thing, especially in the Class A space, is we are dealing with renters by choice. These are, by and large, pretty affluent individuals, and they have a lot of choices. So on average, Class A renters tour 6 to 16, or at least look at 6 to 16 properties before they make their selection. So it's, once again, going back to customer service, making the user experience really easy, having information readily available. If you don't have real-time pricing and availability, along with online application systems and the ability to virtually tour, you are behind the times. So it's kind of being able to cater to all those buckets. I would say in terms of how it's changed, we definitely do more virtual leasing than we did pre-pandemic, and it has stuck around even though we offer in-person appointments all day long, almost every single day. So I would bet it's about 50-50. So we are seeing a lot more virtual leasing activity, but it does not eliminate the need for that individual in terms of a leasing agent.
Yeah, I would piggyback that. There's a lot of technologies. We can show you an apartment however which way you need to. We can send you a video link. We can walk you around on an iPad. We do have the self-guided tours. That's popular in our single-family home environment. You can tour any time of the day alone. We can give you a code. You can go check that out. But we still need the personal element to be checking the systems, troubleshooting the systems, following up with these folks. Even if somebody really likes to be independent and tour on their own and not deal with anybody, it's still beneficial to have a touch point so you can actually close that deal. I think that our leasing consultants have gotten away from the sales piece of leasing. It's customer service and it's an experience, but it is a sales role, and we really need people to be focusing on the sales piece of it. And I think that's another thing in the searching for good talent, is trying to pull that out. And considering segregating that. We've done that on some of our properties where we'll have a salesperson and a resident experience person. So we can give 100% effort to the resident experience, and we can give a 100% effort to the sales experience. So I think that technology goes along with that as well, using AI. That's one of the technology tools that I like is the AI, to be able to respond to leads 24/7. The chat bots, things like that. I know one of our communities had a great leasing week, and we said, what was the trick? Well, we answered the phone. Apparently, none of the competitors are staffed, and nobody's answering the phone. So we got all the leases. Great for us, but having those call centers and having the chat bots and the AI have been really helpful. And I just think we can service that need of the property every which way these days.
So residents expect immediate answers. I think that's the biggest help that technology can be, is that they expect immediate answers, and so you're fulfilling that that need, that role, right? Have you ever been on a web page and it takes too long to load, so you're like, screw this, I'm gonna type it in again or go to a different one? That's how our prospects are. So AI as a way to supplement when we can't be in the office 24/7 is awesome, but there again, we just still need those people. So it's like we're continually layering on products to meet prospect and resident expectations, but it really just kind of makes our lives more difficult, to be honest with you, on site, and almost increases the need for body count.
So I think from my perspective, we, as a small operator, we often beta test new technologies, not always to a success, but I think one of the things that we found too, right, we do all of our marketing internally. So we have a marketing team, they manage all of our Google spend, digital ads. And so we do a lot of research, are able to be really hands-on with that. And I think AI is something that has really benefited us. I think 50% of our leads come in after hours, so you don't have someone there to answer the phone or to respond to an email. And I do think, as we survey prospects, that's what they're looking for. They're looking for instant information. But in Minnesota, they still need to come in and kick the tires, right? They need to come in and they need to see it and they need to make a connection. So we survey all of our prospects through Satisfax. And that's a comment that we get back all the time is, I really liked the leasing person, and typically those people will rent from us. So I think AI has added a lot for us, but I think, yes, having a person in place is incredibly important. We have been able to cut back on our leasing staff because we have centralized some of it. So we actually have some folks that work, one's in New York, one's in California, and they actually manage our leads during business hours so that our leasing folks can really stay focused on the sales process. So they're closing. They're constantly talking to people, and then the managers are really interacting with residents. And then we have other people in other states answering the phones for us that work for us. So because we want to make sure that it's not a call center, it's really someone that works for us that can deliver the right experience. So I think that's really helped us cut back on some payroll cost and helped us with responsiveness to prospects. I think that's where we lose people, is when we don't respond.
So I think this was from a Yardi conference, but nationwide, 60% of renters are comfortable leasing sight unseen. And I don't think that is Minnesota by any means, but is that coming more? And the active leasing process is about 3 weeks long, and 2 of those weeks are silent from our perspective. So what is happening in those 2 weeks? People are online. People are looking at your reputation. Sometimes our Google rating might be driven by angry residents. Well, how can we be providing great customer service and soliciting those strong responses so that when others are shopping during that 2 weeks where they're not talking to us yet, they think, hey, this might be a good place to live. So that's a huge part of it for us, and centralizing, what we can, making sure we have strong marketing in place on that front end. And, when people used to call, we try to be qualifying, and now people have self-qualified. They know, this is on the top of my list. And if you answer the phone, if you're the first to respond, there's a stat out there, if you're reaching out to a number of companies, the first one to respond has a 70% likelihood of getting that business. So how do we be the first to respond, whether it's a great chatbot or whether it's a great conversation on the phone, email, what have you?
I think the guided access component just sort of like opens up the friction that sometimes happens for like the modern buyer of just knowing that they could, figure something out at midnight and schedule it and go do it on their own. And even if they ultimately end up meeting with someone, it becomes this, frictionless experience that, isn't a barrier to start. One thing with kind of the software is we sort of ultimately end up being, sort of a consultant to a lot of our customers on like, here are all the different technologies, here's different ways that we can go about it, what are your thoughts? So we're sometimes that first layer of just sort of determining like, is this real? Is this beneficial? Does this fit with everything else that you're trying to do from a technology standpoint in the space? And so just being sort of careful with, not getting distracted by shiny items and having a balance of shiny things that are functional and things that help drive residents.
That's a good segue to the last subject here, which is technology, which we've talked about several times this morning.
Is there anything new in this space that's catching your attention? And if so, what? But if not, how are you approaching the technology integration challenge as you build out your capital stack?
No, I mean, everything has been around. I think what we just continue to see are new iterations of it, right? So Yield Star is now AIRM and, you know, what have you. I think I'm going to be able to kind of cheat the second part of the question, and that Greystar is very rigid on what will integrate with our property management systems. You have to have gone through national level beta testing, giving us best price, and then maybe we'll let you in, maybe we won't. I see my director over there giggling because she knows it's true. So in terms of handling the integration, we kind of have it easy on from an operations perspective because we are told as managers what we are able to use from our national teams. But I think it was Jamie that said, you know, don't get distracted by shiny objects when we were doing our prep call, and I think that's so important because you can spend thousands of dollars, hundreds of hours, literally getting something integrated with your property management software and paying for the coding, only to have it suck or break, and you have to find a different solution. So honestly, going with vendors you trust, I think if it is a product that is under the umbrella of your current property management software, it's probably a safe bet. As we know, RealPage is basically the Greystar of property management tech. They just keep buying everyone. So you can probably find something to integrate within that stack. Same with Yardi.
I'd say Lincoln is similar in the way that we're vetting these vendors, we're signing a master service, you know, agreement for the portfolio and things of that nature. I think where it becomes challenging is we're fee managed. And so we have, you know, our clients who see a red shiny ball and, you know, want to incorporate some software, or they just have a different platform, or there's a utility benchmarking system, and, you know, you name it. So right now, I believe we have 140 softwares that integrate with Yardi every night, which is a lot, and a lot of room for error. So moving forward, we're trying to minimize that and offer, you know, whatever the service is, you know, desired. Here's the two options that you have to choose from to try to reduce the number of those softwares that we have integrating with our systems every day.
So we are the beta testers because our portfolio is small. So we try out a lot of new technology. Well, we did. So we're just under 8 years old. So we're a new company. And I think one of the things that was really important to us was to try those things. What we discovered very quickly was exactly that. We're spending a lot of hours, a lot of money. And so what we did is we built a task force. So we took someone from every department and they come together every other week to discuss technology. And really what we've ended up focusing on, one, it has to integrate, we use Yardi, so it has to integrate with Yardi. But what we're really focused on then is trying to build efficiency, right? We're all concerned about expenses. And so we're trying to find ways to save money through technology. And so that's what we've really begun to focus on. And I think there are some really cool things out there. It's a matter of, can you get them to integrate? How painful is this going to be for the on-site team? You have to get buy-in. So you have to convince them this is going to make their jobs easier. And that can be a challenge sometimes. But one thing that I have been asking the team to do, and they're always hesitant to take on another technology, is I've been talking to someone, a colleague, about it's a platform that you can run automated lease file audits. Wouldn't it be great to be able to click a button and have your entire property have a lease file audit?
Your community manager.
I know, right? So, I mean, there are really cool things out there that can add a lot of efficiency. I think it's just a matter of implementation becomes a...
Who wants to fund Jamie? We're fundraising for her now. We're all leaving our companies. I'm gonna work for her.
Kind of to piggyback on that, we recently were exploring new screening providers given fraud issues and concerns talked about earlier. And yes, we integrate with Yardi, here we go. Okay, this is gonna be great. Learn, we need to redo all of our websites so they integrate, but you know, this. So it's hard, it's challenging. And everything is a technology solution. So I kind of joke, dog waste. There's a technology solution for dog waste. So there's a technology solution for everything. And so the technology stack can be, you know, as big as you would like it to be. And
Alex.
Yeah, so from a vendor standpoint, I think, the ultimate goal is that, all the software is stacked within each other. But the challenge is that everything is interconnected, right? And we'll continue to do that. And so, the Yardi, for example, or RealPage, right, which are property management softwares, understand that. And so they're bringing in companies or buying companies to try to facilitate that and make things easier. The problem is that they're not always buying the best company or the right company, right? They just know that they need to do it. And so from a vendor standpoint, we're sort of always juggling, like, is the convenience worth the quality of the product, the reliability of the product from the hardware standpoint? And so I don't think that at the moment is figured out, both on, the Yardi and RealPage side, for example, not to, throw them under the bus, like they're trying to accommodate. But I think there is this balance that needs to be kept between what is the ultimate functionality that needs to happen in the building. And I think like access control, for example, is an important one. That's not one that you want to not function. People need to be able to move through the building and get in and out. And so, is it maybe okay that we're going into this other software to add residents and remove them, and it doesn't ultimately speak to Yardi? Or they'll say that there's a Yardi integration, but it's not really all that integrated? Or, do we want to use the access control system that Yardi just bought, that they're just figuring out, and now we're beta testing it throughout, for example? There's just this balance, and there's so much that kind of comes at everyone with the shiny objects and with the conveniences. But I think as we've all experienced, software can be tricky and a challenge to bring on and evolve through everything, and it's tricky to have a perfect answer, silver bullet.
Thanks. And I'll just put a plug in. The latest issue of the MHA Advocate magazine does a deep dive on technology and innovation. Make sure you find a copy of it. There's some really thoughtful advice in that issue. So with that, I want to keep you from your break. Please thank my esteemed panelists. And I think we're back at 11:25.
On to our next panel, multifamily development in 2023. David Miller, owner and principal of UrbanWorks, will be moderating this panel. So let's please welcome David and his panel.
Hi, everybody. Thank you. My name is David Miller, and I am a principal and architect with UrbanWorks Architecture. We're located in the North Loop neighborhood of Minneapolis. We are a 25-person architecture and interior design firm focused on mixed use and multifamily projects over the past 18 years. And with me today are our 5 esteemed panelists, one of them virtually, here to share their wisdom about multifamily development in 2023. So to kick us off, I'd like to go down the line, have them introduce themselves, and in just a few words, reflect on where their focus was in 2022 and how that may be different or stay the same in 2023.
My name is Trevor Martinez. I'm a developer at Sherman Associates. We are a roughly 600-employee organization that does the full gamut of the real estate spectrum, with the one exception being industrial. In terms of changes from 2022 and 2023, as we look back on 2022, I think a lot of us spend time adapting the capital stacks of our existing projects to reflect the realities of today's capital market. And I think in 2023, you'll see significantly more execution, as well as a small shift in product type for us, as well as some pretty large geographic expansions. In 2022, we acquired our first property in Florida and are continuing to expand into the Southeast, Colorado, and then broadening our footprints here in the Midwest.
My name is Kent Roars, Roars Companies. We have predominantly been in the development and management in the past. We did add a construction arm as well. So now we do the pretty much full life cycle in regards to development, construction, management, and asset management and such. So our focus in 2022 was to sell some of our assets, as we knew the market was favorable in regards to selling into that. We sold some non-performing assets. We sold some performing assets that did very, very well. And then our big push was on the development side. So our goal was to do 22 to 24 development projects last year. We fell short of that, mostly due to the financing in the last quarter and some of our low-income projects. So we did start off 17 projects last year. Because we ramped up and pushed so hard on the development last year, and it was a firm-wide effort, this year is all about execution in regards to doing the construction and getting those projects going.
My name is Katie Anthony. I'm Vice President of Development with Schaefer Richardson. It's good to see you all today. Thanks for having us. Our firm we're about a 30-year-old firm. I lead our development team, and our other kind of forward growth business is our private real estate investment trust. In terms of 2022, a lot of it was trying to keep projects alive and trying to keep them together, starting out at the first half of the year with construction cost inflation and gaps being created on our deals from that. Second half of the year with interest rate increases and some struggles with that. We did sell an asset, had a great return on that in the first half of the year. We're looking to do more of that in 2023. Also, have a number of closings, both in the affordable multifamily space and the market rate space that we're looking to do in 2023 as well.
Well, the crowd is really thinned out with all the bad news, and we're the developers, the opportunistic ones in here, so I figured we'd have a better attendance. My name is Josh Branstad. I'm the president and owner of Greco. We're a local development group. We've been around for about 20 years. Really, we've primarily historically been focused on urban redevelopment and revitalization. About 6 years ago, we really pivoted towards more of a suburban focus, and as we look back at 2022, as we came into the year, we had 2 new projects opening up. We knew we needed to get them stabilized as quickly as possible. I think the writing was on the wall. Things were going to head south, and they did. And thankfully, we were able to get our projects stabilized early in the year, get them refinanced. Our last project we refinanced with a 4.45 interest rate, and we thought the world was coming to an end at that point. And you look back today, and we're looking north of 6. As we look into 2023, a lot of the work that we did in 2022 was really to queue up 23. We've got 2 large redevelopments that we'll break ground on kind of summer and second half of the year, and we really look forward to jumping into those.
And I just got word that unfortunately our virtual panelist, Maureen Michalski, won't be able to join us, so we'll just get right into it. First, I'd like to talk about the economy and how are interest rates and the economy impacting your approach to development. And I'm going to turn it over to Kent to kick this off.
Yeah, we get a lot of questions in regards to, how are interest rates having an effect on our projects. And we have a private network of friends and family, we call it, or high net worth individuals that invest with us. And so we raised about $125 million in that last year. We've raised about $500 million in that in the last 11 years of our existence. But it's always asked in a vacuum, and I say that to the investors. You're like, oh, great, interest rates are going up, but it's only happening on apartments, and it's not. And so while it costs us more, and I think the last project I took a look at cost us $470,000 for the 2 years that we were in construction to build that project, to have interest rates, up 1.5% or 2% from where we were. But at the same time, that's affecting buyers from being able to buy homes, right? Because interest rates have gone up on the interest rate cost side of a 30-year mortgage, 3 times. So it's not 3 times the payment, it's 3 times the interest rate expense, right? And so people are having to rent homes longer. Rent apartments or housing units longer, which creates more marketplace for us. So I'll give you an idea and an example. In Maple Grove right now, we're building behind the hospital off of Maple Grove Parkway. It's a 255 unit project. It opens up middle of this month. Of the 255 unit project, we have 150 units rented up already, and we haven't even opened. It's 2 more weeks, right? So the demand for the housing continues. So interest rates, yes, are affecting the projects. They're a little bit tighter. But I guess why our firm is gas pedal down full throttle yet. We plan to do 20 projects this year. We have 14 projects under construction right now, and 7 of those are in Minneapolis. And the reason we're so bullish, again, is that we think interest rates will come back down, which most people are predicting in 2 years. And in 2 years, when that project is opened, it's stabilized, and it's operating, again, we incurred a $470,000 increase in construction financing costs during that period, but then we can lock in a permanent loan at a lower rate than we're at, and we'll be ahead of the curveball from other people that have slowed down during this time, when I think there'll even be a more and bigger demand for multifamily housing.
Can you speak to any challenges that you've been facing with land acquisition?
Yeah, so on the land acquisition side, most of you are people who are in touch with that just as much as, and maybe more than myself, but, last year was the market to sell. And so the challenges you have is just like if somebody's in the stock market, right? They remember the price or the high they had. So when we're working with these people, it's like, oh, well, last year somebody offered me $10 million. And it's like, well, great, that was last year, right? So we have seen it start to shift from a seller's market to, something in the middle. But we've gone back to even our sellers now and been kicking back our purchase agreements and such. So it's had an impact already. I wouldn't say that we've been able to drop those prices, but we have been able to get them to negotiate on some terms.
How about locations that folks are focusing on, the inner core versus suburban markets? Trevor, any thoughts on that?
Sure. I mean, I think that you've heard a lot of panelists today, talk about the boom in terms of moving out to the suburbs in Minneapolis, and I think that is true here locally. I don't think that that's true everywhere geographically. In a previous panel, it was talked about how we spend, as a percentage of our income, we are the 89th in terms of cost in the country. One of the big reasons why we've seen massive rent growth in some of the places like, the Austins, the Denvers, and a lot of places in the Sun Belt is because the people that are going there are migrating from very, very high cost, probably the top 10 or top 20 as a percentage of income portion of the, as a portion of your total income spent on housing. And so Minneapolis isn't necessarily attracting as many people from those markets. And so the market here is used to a certain, penchant and or clip. I think that suburban growth will continue to be strong, but I think that there's a very large place for either adaptive reuse and or repositioning of existing, B and C class markets in the core.
Any other thoughts on inner core or suburban markets? Katie?
Yeah, we do work in both the core and suburban markets, and to a certain extent, I would agree. I think we've seen such an increase in supply on housing in the core of Minneapolis and to a lesser extent in St. Paul prior to the pandemic, and that was part of the resurgence of cities across the nation. There's a lot built and a lot delivered in the last 3 years in those markets, and we're still going through absorption of those units. We have assets in Northeast Minneapolis and the North Loop that remain, very low, have very low vacancy rates. We do have to offer some concessions in those markets, which we don't have to do in the suburbs, but we've continued to see rent growth in the cities, and we've continued to see low vacancy rate. There's interest in living in interesting places, and I think that will only continue as Gen Z comes to the age of being renters in the rental market, and there's more interest in just being in a vibrant place. And so I think we're still absorbing quite a bit of supply in those marketplaces, but I don't think that the cities are dead.
Yeah, I guess I would just add to what Katie's saying there is, we're a small group. If we do two projects a year, it feels probably like Kent doing 20 projects a year. We can't keep up with that. So we really are hyper-focused on all the details of our deals. We just don't have the team and capacity to really scale to multiple developments a year. But, where we've really put our focus over the last 6 or 7 years are pro-development communities and municipalities, work alongside of the city administrators, planners, city councils, planning commissions in those cities to really try to deliver on something that a community-based need is. I think of the example this last year, we completed a project in Champlin called the Bow Line, and it's part of the Mississippi Crossings District redevelopment. But that was a project that had been in some sort of fashion for about 20 years that the city had owned this land, and they were motivated to get something done here, and they had a big vision, and we bought into their vision. And and through time, that vision kind of morphed and whatnot, and it came out to be what it is today, where they have a new public pavilion that the community gets to use. There's a riverfront amphitheater, a bunch of different improvements along the riverfront for the community to use now, and then there's a restaurant coming this summer. We delivered 212 market rate apartments, but it was really a project that I think exemplifies our focus on finding really well-located communities that haven't had a ton of development in them. They have pro-development councils and staff, and then also they have a really good connection to the outdoors. I think, you know, during COVID, we saw a lot of that in our suburban projects. At the time, they really performed well. I think because of that, people could get outside, they could go out and do things, they could stretch their legs, jump on a bike, go for a run, you name it. And so that's really become a primary focus of us as we've looked at new development, you know, going into the future. So our focus probably won't be as much on, you know, urban core development, but we will definitely stay highly focused on, you know, pro-development communities in the suburban rings.
Has any of your focus moved regionally or nationally, and why?
Yeah, I can jump on this one. Can you pull up that chart at all? So we've gone from a Midwest or Minnesota focused firm here to a national, and just in this last year. So we have right now 3 projects going on in Utah, and adding another one there. We have 3 projects going on down in the Austin area and a few in the Dallas. So we're moving to that Southeast and Sunbelt region. And the reason is just that's where the people are moving to, right? So we love Minnesota, and it's our staple and always will be. And we still get investors who say, hey, I like the inner core of the US versus some of these coasts where everybody else has been running to for a while. But we have started to expand outside of that. So we are actually expanding right now into 7 new states. So we'll go from the 7 that we are in to the 14. But one of the things I asked them to put up on the board here was what I would call a cute but non-political map. And it's from U-Haul, right? So all it is where are the trucks leaving and where are they getting stacked up, right? And so the orange dots show where they're leaving. So it's the California, it's the Minnesota, it's the Illinois, it's the New York. And where are they stacking up? Where can they like run out of room to store the trucks when they're unloaded? And that is the Florida and the Texas, and you know, go through the different states, but it's just really clean and easy. So we just take a look at this with all the other data, but it's just where are people moving to? And rather than just continue to focus here in Minnesota, which we love, let's go elsewhere. Let's go where the people are actually moving to and where that housing is needed.
Yeah, painting in broad strokes, real estate generally follows demographics, and so things like, you know, this U-Haul chart or the national population moving maps are you know, have been big drivers, and where Sherman has gone to expand to as well. And we're now we now have full-time development staff members in 4 different states, and as of 2 years ago, we were all predominantly focused here in Minneapolis. I think as time goes on, we will continue to have some shift nationally. It's not because there, you know, are insufficient or no development opportunities here in the Midwest. It's just that if it is possible to scale the strategies and the lessons that we've learned here into some of those other markets, we think that we can offer a differentiable price point and set of market deliverables in the competition there.
Can you all touch a little on the cost challenges, whether that's construction costs, operational costs, what your expectations are for the coming year, and maybe any strategies you use to mitigate them?
Well, I'll jump in. You know, I think what we saw in 2022, the rate of change that the costs were happening was it was a phenomena. You couldn't keep up with it. The GCs couldn't keep up with it. You know, we'd price a project one month and the next month it's 5% more, the next month it's 3% more. And, you know, they show us these emails they're getting from drywall contractors, roofing contractors. Hey, you just got a 15% increase on your drywall and your painting. Your roof just went up 20%. And if you don't lock in the next 2 weeks, I can't guarantee that price for the next 30 days. So sorry, but I've got 20 other GCs that need my services right now. And what I think we've tried to keep up with that, and obviously you can't. You know, when we look back at we're building a 3rd phase of a project that will start here the second half of this year in Shoreview, Minnesota, but we are building almost the exact same building. 6 years later, it's 50% more. Rents didn't go up 50%. The finishes really didn't change. The building hasn't really changed. The footprint hasn't. But the just sheer commodity cost and labor costs have gone up 50%. It's just astounding. And when we look back at kind of 2022 and where we've gone to in 2023, and I don't know if anybody really knows where we're going, but it really feels like there's a little bit more stability in the pricing markets. Things are a little more on the known, and I think there's a lot more prediction as well from a supply chain of when you're going to get your stuff. I think that one of the big risks we really talked a lot about before we decided to go, right as COVID had, broke loose, we took a 30-day pause on 2 projects and really analyzed, were rents coming in, were the fundamentals staying there, were people losing jobs, were they moving out of our buildings? That all held true, but one of the big unknown concerns when we went into these projects, what if we can't get our stuff? What if we can't get our drywall? What if we can't get our carpet? What if we can't get our LVP flooring? And you're in the middle of a project or your appliances, and you're supposed to be delivering in month 18, but now you can't deliver until month 32. How are you going to absorb all that interest carry? Who's going to have the guarantee tapped on the loan? Those are the types of things that we were really concerned about. I think there's been some stability that's really come through, over the second half of this year. Yeah, we don't like the cost and the inflation, but it feels like as we head into 2023, those things are starting to flatten out. And if everything holds true from what we've been hearing, really the second half of this year, we might even see some of that pricing come in.
Yeah, and I'll similar to you, Josh, we have a back-to-back project that's in the suburbs. It's 3 years later and 36% higher in construction costs. And I heard on the lenders panel, somebody referenced that we're at rates today that we were really at just a couple of years ago. Pre-pandemic, it wasn't unusual to be sizing at a 5.5% rate. I think the difference is that construction costs have gone up that much, and they haven't come back down yet. So it's just harder to make deals pencil. What we've seen, we have a number of projects that we're bidding right now, and at the first half of last year, what we were seeing is every 6 weeks or 8 weeks, when we would get new numbers from the contractor, we'd have to go back to the drawing board and figure out how to make a deal work. So through value engineering, through redesign, what we're seeing at this moment is that those costs have stabilized and even come down a little bit. And it depends on the materials. Lumber is certainly not as much of a bogey as it used to be. Who knows where that will go, but it's other pieces of the equation. What we've heard from contractors are that they're getting more bid coverage from the subs than they were previously. Subcontractors are looking at their forecast and wondering where the next project will come from. And so there's new names out there that we haven't seen on the sub list previously. And we're just getting slightly better numbers and smaller margins than we used to. And so that's potentially a silver lining or moving towards that equilibrium. But it's a long way to come back from when you've gone up that much over the years. One other strategy that we're using is just really refining our design. And so any areas where we can cut excess square footage out of projects, tightening things up, focusing our efforts on really good floor plans that are easy to lease and function really well. Focusing on amenity areas that are in high demand and making those beautiful, spend our money there, and the functional areas of the building, and not wasting money on things that people don't really want.
All right. Well, I want to shift a little bit and talk more about building types and product. Where do you think the opportunities and challenges are right now for repositioning or converting different building types?
Yeah, I think that I can take on this one. Sherman Associates has been, fairly prolific converter and adaptive reuse of a variety of different buildings around the Twin Cities, whether that's schools and now it's expanding into downtown office buildings. We have 2 very, very large, sizable conversions that we have planned that have been, in the papers and otherwise. The North Star Center in downtown Minneapolis, as well as Landmark Towers in downtown St. Paul. I would say that number one consideration in terms of our mind is the building, what restrictions are there on the building in terms of existing leaseholds that are still there? B, can we get it at a reasonable price? And C, is it going to be eligible for historic tax credits? there is a sort of flawed, thought around the repurposing of office buildings, that because a shell exists, that it's going to be easier or it's going to be less expensive to convert those buildings to housing. However, I think the more apt analogy is more like trying to build a ship inside of a glass bottle, that it is significantly more difficult to parse apart, the individual and have to rebuild the entirety of the internal structure of a building without being able to disturb any of the exterior of the building, or the structural supports that are inside. I think that there is a lot of opportunity for redevelopment of those, struggling, particularly Class C and or historic assets. And I think that you're going to see, more and more innovative nominations for things like the National Register of Historic Places. One of the buildings that we are working to convert right now, Landmark Towers in downtown St. Paul, is a 1980s built office building, and it is now on the National Register of Historic Places. And so being innovative with envisioning these buildings to see if they have a future and can be converted, do the floor plates align such that you can have a reasonable depth of unit, or is there going to be infinite dead space? The other piece of it, retail structures and strip malls, I don't think that you're going to see those be converted into housing just because they don't lay out particularly well for that. I think you may see in certain struggling retail communities some scraping and some acquisitions at fairly low essentially land basis for those projects in order to continue on. But the biggest key that I think that we're going to need to see moving forward is that the state of Minnesota needs to bring back the state historic tax credit. I think there's a lot of momentum at the legislature to make sure that happens. This year, it unfortunately did not pass on a tax bill after the last cycle, but I think that there's a lot of people in this room that are hoping to see it pass in the next.
Are folks doing other things to help balance market demands for both the near and long term?
Yeah, I could jump in, I guess. So where we've been primarily focused has been in the fast-growing suburbs, like a Lakeville, Maple Grove, Woodbury, so on. And we've been very successful there. But we've also gone into some cities like Fridley, and where we bought, an old strip center that had definitely had its time and was primarily empty, and vacated those people out and knocked it over and put up a brand new building. That building, for instance, was one of our larger ones, and was one unit short of being completely full the day we opened. So those locations are phenomenal. And so we've really bifurcated our focus on what are the fastest growing suburbs out there that probably need some housing yet, and what are those cities that are more mature that maybe their housing stock is not where it used to be, and trying to work with the cities to get some support. Is there availability for TIF or other means at which they can help support to bring down that cost, knowing that the rents may not be what they are in the growing suburbs? So it's really been those two focuses for us this last 2 years.
Yeah, I think, Ken just hit the nail on the head. Building a high quality, well located and appropriately designed and amenitized building in the right locations prevail, period. I think, the projects, I think a lot of the ones that the first panel was talking about that maybe will be opportunities at the midpoint of this year were, really hard charging, fast moving developments that maybe didn't go through the level of detail that they needed to really maximize that value and have the staying power during a downturn like this. So I think as we look at that, going forward, what that means for us in our projects, really our unit mixes have not changed all that much in the last 5 to 6 years. I remember when we broke ground on our first phase of 3 up in Shoreview, we wanted to do 20% of the building as 485 to 525 square foot units, and our market study thought we were absolutely crazy. Our lender thought we were crazy. We did it anyways, and they're the first ones to fill. And before the building even opened, they just went, and they're at $250 a square foot in rents. It's just stuff like that that you're learning through operations and year over year and whatnot. And as we continue to move forward, we want to also do well-appointed 3-bedrooms in these suburban communities, because we've seen a really high demand from that 45 plus renter, but it's got to be appointed right, but they'll pay the rent. I think one of the units that we are ready to kind of get rid of as we go forward, we don't do micros. We did a handful of those in the North Loop. You just don't get rent growth out of them. It's just that renter can only pay what that renter can today. That's the same amount that renter will be able to pay in 5 years from now. That's our theory on it, at least. The one unit we do want to get rid of is the 1,000 to 975 square foot inline split two. It's obviously the entry level two-bedroom apartment, but it's an apartment that there's just an abundance of it in the market. It's the one we always struggle with the least, the most. But we know that's always going to be a component of our mixture. But so we're really trying to focus our unit mixes and building layouts to more of a 1,100 plus square foot two-bedroom. We've seen a really good response in the marketplace from that, and there's some details behind why that works. But other pieces, as we've moved through, the pandemic, and now the shifts now with demographics and where people are living and what they're desiring, I think what we've really realized is that fully amenitized, well amenitized buildings are an absolute need for the demographic that we work within. The majority of our projects are anywhere between 175 and 225 units. And when you get to that size, I think that renter has a level of expectation of they want that full lifestyle amenity package. And so really all the developments we do going forward are going to have that. Otherwise, we probably have to pass and move on to new ones.
Yeah, and I think for us, our demographics are getting older in our rental buildings. So whereas we used to have a lot of young professionals and maybe a handful of empty nesters are really starting to skew where, especially in the suburban market, more empty nesters as well as just older renters in their 30s and 40s. We've seen a lot of strength in the studios and one bedroom marketplace, and that continues. And I think likewise for some of those people who are downsizing, having units that are an easier step from a single family home to that rental. And there may be a future step that is smaller and more size appropriate, but a unit with good storage available at the building, a space where you can host Thanksgiving dinner somewhere in the building, even if it's not in your unit. And you can still kind of do the things in your life that are life-giving, but live without the hassle of owning a single-family home. And so looking at our amenities that kind of meet the needs of that young renter and an older renter and can build community that way.
I'm curious, Kent, are you seeing any trends locally in that regard versus the national markets that you're working in?
In regards to rent up or?
Demographics, unit mixes, any pivots in how you're approaching that?
Yeah, so I would agree with Josh. We're doing the same thing in regards to those two bedrooms. There just is so much of them. They're the last units to rent out in every project that we do. It is our one bedroom and even micro units that rent out first. It's that renter that says, I love the building, I love the amenities, what's the cheapest way I can live here? And the three bedrooms. So that middle section is always what we're told is needed for the maturity of the building long term, but they are always the last ones to rent out. And I guess our experience in going outside of Minnesota has been the same. So we haven't seen a difference in that by geography at all yet.
I'm going to provide a little bit of a contrasting viewpoint here that's probably new to Sherman in the past, call it year or maybe 18 months, is that in the broadly nationally, I completely agree with everything else that was said on the panel. In the Minneapolis market, we have seen a trend to some of the larger unit sizes with household formations going down and people deciding that it is more preferential to split a two-bedroom as opposed to having two separate studios that are the same price or more expensive for that same package. We actually have seen a lot more demand, particularly in our one-bedroom plus den units, surprisingly, that were previously only like interior corner unit designs that were finding new ways to try and create those one-bedroom plus dens for people that are working from home or otherwise just want a little bit more space than maybe what they had during the pandemic. And so we've definitely seen our average square footage on unit sizes grow to those 1,100 plus square foot two bedrooms. I think that the demand for three bedrooms is moderately faltering and is now competing with some of the single family home rental product that's a little bit farther out in the cities. That has kind of been a demographic trend. Now, whether there's a depth of market for renters that are willing to pay $4,000 a month and commute for an hour, I'm unsure of in the long term there. But I think that we have seen some shift in Minneapolis, at least in Sherman products, that the average square footage of our units over the past 24 months are certainly larger than what they were in the average 48-month period.
What about the C word, condos? Is there any interest in venturing back into that market, or what would have to change to have that be something you'd consider?
We did a condo project a little while ago. We've actually done a few of them in over our history. One of the things I learned, and my predecessor, Arnie Gregory, is a pioneer in the condo industry, had a ton of success in it, townhomes, et cetera, started our group. One of the things he always pounded into my head is he said, you can't control what the market's gonna do. You can do everything else right, you can design it right, you can build a perfect project, but I think today is just such a good example of that. Think about designing, pre-developing, and getting a project in the ground and delivering a condo building today. And I'm not talking, the very high end like a Four Seasons or 11, which are just really unique product, but I'm talking about a workhorse condo product that interest rates jump to 6.5%. People can't afford to buy your product, and then what are you left holding? That's why I guess our focuses will continue to remain in apartments.
Yeah, expanding a little bit on that, we have a handful of buildings that were built with the ability to transition in the future to condos that we could break up and sell up to condos individually. And from an economics perspective, we've looked at doing that and found that even with today's cap rates, those institutional investors are willing to pay more money on a per unit basis than if we took every single one of those units to market and sold it. And so I think until that dynamic sort of shifts or changes, there will be a hard time, with selling, individual condo units at mass scale than there were before. I mean, there's obviously the other challenges, whether it's liability related or just, competing price points. The other C word that I think is slightly less talked about is co-ops and their, recent prevalence. And I think that there's a lot of future growth in that market, particularly because you don't need to be building those structures out of concrete or steel. The vast majority of those built in the suburbs have been wood, which is significantly cheaper and at a price point that's way more viable for an at-scale product to be delivered across the metro.
All right, well, let's shift a little and talk about communities and cities. What are some of the changes that you're seeing in how cities work with developers?
Sure, I can start with that one. So I think, we're used to working historically in the urban core where there's clear processes in place. There's regular planning commission meetings and city council meetings, and people know their zoning code. There's neighborhood organizations that you can reach out to kind of get a temperature on what you're proposing and gain support that way. The politicians are readily available. I think that continues. Cities are challenging to work in for other reasons, but the process is clear and you kind of know what you're getting. I'll say that as we've moved into the suburbs, it's a different experience. There are some cities that are clearly pro-development. I think, Josh, you talked about, finding staff that will work with you, finding cities that are familiar with TIF and willing to give TIF for affordable or even non-affordable projects if it adds value to their community, that there's a clear process around education of maybe a planning commission or city council if they're not used to reviewing large-scale development projects. There's a certain amount of, change is hard and fear of the unknown is hard. So we do get some pushback in the suburbs from neighbors on what it means to bring a multifamily building and all of the kind of negative connotations that come along with that. So, I think that we've run into some challenges with suburban communities just on understanding what it means to have a development project and the benefits that come with having more residents in your city and increasing the tax base for your city. But certainly there are a lot of communities out there that they understand that they want good development projects. They can command that through the use of incentives like TIF. And those are the places that will continue to see growth and where developers will be knocking on their door.
What about?
Actually, I'll add to that because I forgot to mention. We've seen a number of RFPs from cities come out in the last. They always do, but particularly in the last 2 years. And there's a wide wish list of things that developers or that cities want to see. And one piece of that is a move towards more non-traditional and emerging developers, which I think is really refreshing, actually. It's development is a field where it's a lot about who you know, and it's hard to break into. And if you don't have the capital resources or you don't have the guarantor able to back up your debt, especially in today's market, it's really hard to make that next step. And I think that's something that is it challenges the traditional developers to stretch ourselves a little bit and think about how we can support others in the field who maybe are non-traditional. And so I think that's something that's it's a positive change in what we've seen.
And Kent and Trevor, are there any comparisons that you can draw with working with local municipalities versus the regional or national ones? Is there a reason that you would go to one city versus another?
Yeah, for us, it's been, again, Roars has only been around for 11 years and we started it. And so what we love about the suburb cities is they very easily and quickly tell you they are pro-development or they're not, and then you could just move on. So we love that, and we seem to get and have a lot of speed and progress with those suburb cities. So that's predominantly where we have focused and liked. What we have noticed in some of these growth areas that I showed on the U-Haul chart is that normally where it would take us 7 to 8 months to get through planning and zoning and everything with the municipality here locally, it's taking us 20 months down in these other municipalities. So in Austin and Nashville, these areas, they are just overbooked. I mean, we're one of 60 projects sitting on their desk, and there's just a few people staff-wise that are there. And so on some of our affordable deals where bonds are coming up and due, we've actually had to fly down there and sit in their lobby for a few days till they pull the packet out and take a look at it with us and approve it. So that has been something that we've noticed and has slowed down our change and pace of development in some of those more southern states.
Yeah, I couldn't echo that more strongly on some of our projects that we've had nationally. The timelines in Minnesota, it's like we go back and forth and we argue about the difference between, a really, really aggressive and fast 4 months versus a slow 8 months. And, when you're talking nationally, it's 12, 18 plus months until you can get to site plan approval. And that expands, even more when you have large, very large scale master planned, community style entitlements. And if you have multiple sets of review boards or neighborhood organizations that have to provide additional steps and input along that process. I mean, nationally, the bigger issue I think has probably more been around impact fees, even though there's been a lot of, conversation around that here in the Twin Cities as well. But, in terms of impact fees, the Twin Cities is lower, generally speaking, than a lot of the rest of the country, particularly in water-constrained resource areas.
One of the things I forgot to bring up earlier when we were talking about land prices in a seller's market versus a buyer's market is that what we noticed when we went down to these cities like Tampa and Nashville and Austin and others was that we would sit down with the landowner and say, gosh, we really like your piece of property. We want to do something. Let's put it under a contract. We'll put an option on it now. We'll buy it in a year from now. And they're like, well, we were thinking like 60 days from now. And we would say, well, we just can't do that. Nobody else would do that. Well, that's great because there's 5 people behind you that will. And so what we decided is that for us to get into those markets and start to proceed, we needed to have the money. And we'd always had the rule around our office. And we were constrained with capital. So we didn't have the ability to buy large chunks of land or chunks of land and sit on them. We had to do that. And so what we did was we started a fund. It was called the Roars Growth Fund. And we paid people a percentage rate anywhere from 5 to 7% annually for them to put their money in this fund. And then what we did with that fund, and we raised about $30 million, is we went out and bought land. And as we did that, and as we've sold a fair amount, I think we've sold 8 properties in the last year, we kept that capital in the company and added that. So we've got somewhere in the neighborhood of 60 million worth of land, and we've got 30 million in a fund backing that up. So it's taken us going out there and figuring out our pinch point, which was we needed the capital to buy these pieces of property. And what's actually happened is we've been able to sell a few of the properties that we don't like as well a year later and more than doubled our money on them. And so it's been a bit of a profit center Now, again, we're not trying to continue and go and do what people did in 2007 and 2008. We've tried to keep ourselves limited and constrained, but it's something that we've had to do and think about to get that land in those different areas.
Yeah, Sherman has had a substantially similar learning curve as we've done stuff across the country. To bring this full circle back to David's original point and question around working with municipalities, is that doing things like that puts you at considerable political risk, particularly as it relates to funding sources. If you're going after whether it's TIF, tax abatement, fee waivers, things of that in those areas. And I would say that while most of the time things have burn out well, I would say that you learn by burning your hand on the stove more than you learn by eating a good pot of mac and cheese or something like that. And so I think that developers, particularly in this climate, are becoming slightly more risk averse, and we've seen on the land side that the sellers have been willing to have a slightly longer timeline, but I would absolutely echo that in the rest of the country it is not normal to have your project be fully entitled before purchasing the land.
So what are the things that you would like policymakers to focus more of their energy on, or less of their energy on?
I guess I'll go first again here. I think that creating some more transparent rules about a lot of the newer funding sources that have been created would be helpful. A lot of the money that has been distributed, since the pandemic relief efforts, whether that's ARPA funds or the ability to now use excess TIF increment, whether that's the new inclusionary zoning, revenue loss offset TIF policy that the city of Minneapolis has, a variety of these other, new waves of funding for development are coming out, sort of in response to the developers saying that it was really, really difficult to get items closed during COVID. Now, in the short term, I think that that's going to, have the same effect that the massive amount of monetary stimulus has, in which it's going to fight some level of construction pricing going down. It will make developers a little bit more sophisticated, but the, allocators of those funds have not generally had enough time to create, solid rules that developers can use to forecast those tools often into the future. I think a lot of people will harp on impact fees or, some of the entitlement policy, but I just think that having more, open and candid conversations about things that will work, levels of subsidy that won't work, and when the next election cycle is, so that developers can evaluate their political risk, is something that could be, easier from the developer side from cities.
I love Kent's chart. It just keeps things simple, right? And the one thing I've never understood, and we're really not in the space, and I think we're going to start trying to get into the space, but affordable housing, I mean, you have to have basically a PhD to be able to figure a way out and through the applications and when the funds come in, et cetera. It's such a rampant problem in our country, our cities, our area. Why can't we make it simpler? I think that's the only thing I really have to say on that. I don't know enough about it to really, give you much more of an educated insight on it. But I think, it's something that's really needed in our communities, and it's just a problem that continues to get more and more complex as we turn every corner. It's disappointing. It's too bad. I think the other piece would be, rent control is probably the easy target out here, right? We could all talk on that one the rest of the afternoon, but I don't think we really need to get into that. But I would just love to see if is there a way to simplify the whole affordable housing solution?
Yeah, I guess if I was to add one thing, to Josh's point, we made an investment at our firm. We hired about 7 people 2 years ago in the affordable housing process. We brought in the folks that knew what they were doing, and we put a lot of money behind them and really ramped up that side of the business. But to his point, the PhD comment is so true. It is so complex. It takes us about 2 years to do a project. And then just when we're getting to the finish line that we are here in the last 6 months, all of a sudden, construction pricing has gone up so far and the bonds only go to a certain extent. And so all of a sudden we have a project that's short $5 million. And so you can do 1 or 2 projects, but then you can't just keep doing projects that you have to stick $5 million into. And it's a complete change from where we were in regards to what we were thinking in regards to getting developer fees out of those projects as well. So it's very hard, and those people that are in those positions to make those programs work, their hands are tied. They don't have the flexibility to make changes. And so if there were changes that could be made more linked to the market and what's happening, we could continue to solve that problem. But we all see the problem. It continues to grow, and yet the availability to the funds is too complex and complicated to even get the money to make it work.
Yeah, last quick question then before we close out. Do you think there are ways to truly make mixed income properties where you are evenly distributing market rate and affordable?
I do, and the reason why is not because there are tons of tools that are out there today, or because it's easy to do the mixed income 80-20 deals that occurred a lot significantly earlier. But I think that as more cities copy projects like Minneapolis's inclusionary zoning TIF policy, where you have 20% of the units at 50 or 60% AMI, and then the entirety of the building qualifies for TIF, that's one way to generate a significant number of affordable units that do not require bonds in the same level of high-level head-scratching tax-exempt financing that traditional affordable housing projects drive, desire, and work on. The other is to allow for more and to have more replication of these side-by-side market rate and affordable developments. In that case, those affordable units aren't generated within the same building as they would be underneath the first structure, but it does certainly allow for that to happen. Now, that side-by-side structure is even more complicated than traditional affordable housing, so it does not solve the PhD level problem, but it could create an increase of affordable units. The number of bonds, it limits the units not only by, the state's volume cap, but also because as construction pricing rises, the entire market can't deliver the number of units even for projects that would pencil. And so there are some movements on the national level to lower that bond requirement, but it's certainly not going away anytime soon.
Yeah, I'll echo that. We do both affordable and market rate development, and they have different challenges and they have different success factors to them. I think that absolutely mixed income is feasible and is a good idea for communities. The sources have to be there, which I think is consistent with what both Kent and Trevor have said, is that you can't just do it out of the goodwill of your heart. The numbers don't work. And so you have to come up with creative strategies, and you have to knock down barriers, to Josh's point, to getting these things done faster and easier.
All right. Well, in closing, I would like to go down the line here and have you tell me what you think, in just a few words, the headline of 2023 is going to be. And maybe we'll come back next year and see how much of that was true.
Going back to the classics of real estate, the only things that you can control are location and basis, and follow the demographics.
I would say there's going to be generally a slowdown.
I think there's a lot of potential for the year, but since development takes so much time, we have to be risk takers on the front end and hopefully reap the rewards at the end of the year.
Yeah, I agree with Kat. Definitely a slowdown. We are looking forward to trying to get in front of some of those acquisition opportunities mid-year that the first panel was talking about, but on the development front, definitely a slowdown.
All right, well, with that, please join me in thanking our panelists.
So let's get our next panel, Architecture, Design, and Construction Forecast. I think we have Dean DeVolis. There he is, Principal, CEO of DJR Architecture and Design. So let's please welcome Dean and his group.
So you can see it. So that's our official title. But we're going to really step into something that's sort of underlining what's been occurring that all the panelists before us have been alluding to, but actually is becoming a rapidly serious issue that's starting to affect everybody in how we produce, develop houses, how we put it together. So if you go to the next slide, please. That's going to be coming major on this, if the next slide comes. Todd, next slide. Perfect. And you can see below the top.
Dean, it's nap time.
I know, it's sleepy. But if you see below the top, it says the demographic cliff. That's sitting underneath that very top header up there. And you can read the headlines that are sitting there. And this was something that saw a few articles on, didn't seem like a big deal. But then the frequency of the articles kept getting more and more dense, more and more coming. And these are just ones I pulled off just rapidly that I've read, and I'll just read you a few of these headlines. Locally, Minnesota population growth sees concerning stall in the second quarter. The great people shortage is coming. It's going to cause global chaos. economic chaos, the global workforce crisis. The world's baby shortfall is so bad that the labor shortage will last for years, major employment firms predict on this. And Minnesota's in 2023 low unemployment, the global workforce crisis. Will Minnesota be able to stay without growth? This trend has been stepping up and coming at us a lot faster than ever imagined, and it's going to really have to change the way we deliver housing and so forth. Because if you look at the bullets there, the impact of lower population is huge, and what it does is that the fewer people that are, the more we pay for those people, the more we pay for those people, the more the products cost, the more the products cost, the greater the inflation, the more red raises rates, and you can see how that cycle is digging in and continuing. And the fears that inflation may not be transitory because of these factors in the birth rate. Pandemic loss in the workforce, simple fact I'll give you, there's a utilization that the government uses to see how much employees are actually working. Over 55, that rate's dropped to 35%. That means 65% are out of here. And so you're better spread. So that was due to the pandemic. They just closed in and left. Inflation, economic impact, I mentioned already how that cycle is going in, and if we don't deal with it, sort of price ourselves out of existence. It's that simple. And the reason why I put up the war in Ukraine is I just want to give a scale of this thing. If you were to take a line and draw it from Bangor, Maine, follow the Appalachians all the way down, go through Georgia and work our way down the Florida Keys, that's the length of the war front in Ukraine, to give you an idea of scale. And the billions are being poured into that thing. It's a massive war that's starting to approach the scale of what we saw historically in World War II and the costs going into it. That affects everything else above it, the 3 bullets point hold. So there's a lot of factors that are coming at us and coming at us fast that the other panels talked about: inflation, demographic changes, your U-Haul chart, all that kind of stuff that we now have to start working with and start dealing with in order to have our industry not just survive, but hopefully thrive. Next slide, please. And so the next slide just shows a brief example just from our little firm, what's happened so fast in terms of the last 3 years. I thought I'd retire gracefully doing stick frame construction, say thank you very much. Not the case. The old dog has to learn new tricks real quick. So you got several things here. Devin George, he's doing a steel module plant in North Minneapolis. The genius of Rise, Elvira is Rise. MPHA, and that's why Christian's not on our panel right now, he's at the groundbreaking. I've worked with him on. Largest expansion or replacement in public housing in history of MPHA is now modular. And that's what they're doing, having a groundbreaking day at the same time this is occurring. Stinson's Elvira, Mod 42, Stinson is Rise, Mod 42 is Rise. These are wood modules, same with EC, St. Michael's and Gladwood. In California, working on 10 projects that are steel module. That is 10 plus stories. They're asking us to push one for 25, all in steel modular, a whole new method of construction. So you speak of a quick learning curve. World Bank has got us working in Africa to find ways for affordable housing, and Yolanda Jeffries out of Chicago wants to do luxury development out of modular housing. This has happened in the last 3 years. A tremendous amount of change, a tremendous amount of deal. So next slide, please. Now the good news is I have geniuses to my left, or your right, that are addressing this issue and are really working. So I want to do first is let's quickly introduce themselves, and then we're going to have each tell the story of how they're working against this background and how they're succeeding in making things happen. After they tell the story, we want to open the questions from the audience, because we want to hear from your thoughts on this and your background, your ideas. And if you get it, you get yourself a candy bar, Mounds, Hershey's, whatnot. So please go ahead, introduce yourselves.
Thank you, Dean. I'm Joyce Stupnick from BDH Architecture and Design, obviously an architecture and interior design firm located in Minneapolis, and I'm a president and partner there, and I focus my design efforts on our housing sector with apartments and senior living.
Hi, I'm Stefan Michno with Krause Anderson Construction Company. We've been around for 125 years. I'm a senior project manager that works in the multifamily department.
Good afternoon. My name is Mike Critch. I'm a senior design leader
and a managing partner for our Minneapolis practice site.
Good afternoon, I'm David Stahl with Cunningham Group. I'm a partner there and specifically design principal. I work on the multifamily full range from affordable to luxury and senior.
Thank you. So what we're going to do is we're going to start with Joyce. They're going to really talk about how they're working with this new demographic, what's occurring, spend 5 to 7 minutes, maybe longer if you wish, to really talk through this. And then we're going to open up for questions from the audience. I want to just use a canned question. I want to hear what you're thinking and how you're dealing with this. And then they'll be able to sort of talk about their response and so forth. So I'm going to stop now and turn over to people you really want to hear. So Joyce, please go ahead. Thank you.
Thank you. Appreciate it. So if we could just pop over to the next slide. We've got a couple things to show you. I'll give it a second. And I'll just use this time to say that was a big lead-in calling us geniuses. So I will try to live up to the hype. No pressure. Thanks, Dean. So yeah, one more. There we go. Great. Thank you. Yeah. So as Dean mentioned, we certainly have felt a lot of challenges over 2022 and now leading into 2023, specifically in what this panel focuses on in the A&D industry and construction as well. So really what Dean was describing has boiled down to a significant effect on the supply chain, which is affecting how we do our design practice, how we strategize to keep projects on time and on budget. So really what we are seeing that is going to, we feel, continue into 2023 is those supply chain issues leading to rapidly changing availability. Now, I know the previous panel was talking a little bit about that, and certainly there is some light at the end of the tunnel, but we are still seeing significant challenges with that. So 1 minute, 1 day, 1 week, we have product that is available, and it's widespread. It does change month to month. It could be flooring, it could be countertops, it could be carpet, it could be any combination there of those things. So we are still dealing with the fact that we literally maybe a week before have specified a product. The next week we get a call that it's just been discontinued. The manufacturer has shifted gears. And so that'll even happen within the design process that we are, before we've even shown it to a client, we've selected something and the rep calls us, gone. And so that certainly slows down our process as well, that then affects the overall construction timeline and the design timeline. So then, of course, the long lead times, certainly getting a little bit better, but I would say in my world, FF&E is still a huge problem. And we're planning up to a year, 14 months in advance on furniture, just because of the lead time issues. And then finally, there is still a bit of volatile pricing. So that is, and I think it was said by the past panel that, it takes a long time to design and develop a multi-housing project. So we specify it at that design phase, but then certainly by the time that maybe we're ready to order, or, the project was maybe put on hold a little bit because of all this volatility, that the pricing has changed. And so we have to regroup and come back to page 1. So we promised you that we would have some glimmer of hope here, and it wouldn't be all doom and gloom, but there definitely are ways that we can work to mitigate these issues and to all work as a team to get this across the finish line. So certainly one of the things that we are strategizing on is which manufacturers we're specifying, because some have their own manufacturing plans. Specifically speaking towards flooring, even better, some have their own proprietary fibers. They are making their own fibers. So what's going on typically when you're sourcing these materials is, wall covering is a good example. They're all coming from the different vendors, but there's actually only 2 manufacturing plants that are making all the wall covering that are supplying every project across the country, across the United States. So looking then into flooring, when there's a manufacturer that is making their own fibers, because that's similar for flooring manufacturers, they're sourcing from a couple specific sources those actual fibers. If you can find one that's making their own fiber, you have no middleman. They're all integrating their operations, and that's huge. So then second point would be a very proactive approach. I mentioned this for furniture. It comes in many different ways, but really just staying on top of those lead times, thinking that through and strategizing when you need to start selecting and ordering product. Comparatively before, we would wait till even dirt was being moved. Some of the things you can't even wait that long. You really have to get it on it and get it ordered. But tricky part, have to balance that with making sure you don't have a huge gap where you have product you're dealing with additional storage fees, and you just want to strike that balance where you haven't specified and selected it, have a huge time period, and then you can't get the material or the price has gone up. So that it's just that delicate balance act. So then I would also mention contingencies as a way to mitigate a lot of these issues. We are a huge advocate of contingencies because not only in your design fee, your construction budget, your FF&E budget, no one's ever upset when the project comes in less expensive, and you have that contingency there in this uncertain climate in case you need it. So it's a huge advantage in my opinion. And then certainly teamwork, teaming up the vendors, the reps, the design team, the subcontractors, the general contractor, everyone teaming up to work together, to be proactive, to strategize, to talk through what we can do and when we need to do it so that we can come in on budget, on time, and not have these sorts of issues. And then finally, probably one of the key words that has been prevalent over the last couple of years, flexibility, adaptability, not going to go away. And what we are really trying to do is help our clients understand that design that we produce and we've shown you and we've approved and we love, that's fantastic. It's a good foundation. It's a foundation because there's going to be things that aren't available. There's going to be revisions that have to happen. So let's use that as a foundation and come back to it when we need to. And let's have a strong concept developed and goals developed for the project so we can come back there when we need it. But we just have to expect that there's going to be some things that change, and then we can be very adaptable and react very quickly. Just grab a little water.
You're all set? Stefan, please go ahead.
Oh, I'm sorry.
Oh,
Is it okay if I take one more minute?
Oh, yeah,
Sorry.
sorry.
I just had to grab some water. It's so nice and cold in here that
I misunderstood the
everything's
water
drying
break.
out.
Please
Yeah.
go ahead.
Yeah, cheers. No, okay. So then I did want to touch on a little bit of amenities, just segueing that into the fact that we just talked through all these logistical things. What fun is that? That's not what we are about as an industry here with multi-housing and apartments. That we still are very, very focused on the resident experience. And that really is at the heart of our design practice at BDH, is that we take immense pride and we understand the responsibility of designing homes for people. So let's, as we work through all these logistical issues in 2023, let's not forget that we are working towards that excellent resident experience. So with that being said, lifestyle-focused amenities, we still have a core package of the community room, some sort of additional social room, club room, game room, fitness, work from home, still very prevalent. We need to give some work from home spaces and an outdoor amenity. But then we can add on to that and really create some differentiation in the market by considering some of these other amenities that we see prevalence now. Golf simulator. Little did I know, because I'm not a golf player, that this is huge. This is something that a lot of people are getting into, people that aren't even huge golfers, but just from a social aspect of inviting friends over and being able to play golf together. Multiple outdoor amenities. We are now designing 3-4 different outdoor amenities, taking on just unused rooftop space, things like that, so we can give different outdoor experiences. And not only different experiences, but just capacity, right, to have a lot of different outdoor spaces for people to use. Sundries, that is one that we are seeing come into effect, which is interesting, but just sundries, grab and go market, whatever you would like to call that. And a lot of times we build that into the fitness experience so that people can rehydrate or get a snack after they've worked out. But it's about the resident experience and the convenience of that, right? To have some things right at your fingertips. And then health and wellness suites. This goes way beyond just a fitness center. So this is creating a multitude of different fitness types within one central spot within your building. So yoga, bar, fitness on demand, Peloton studio, sauna, all of those things building into one. And then, of course, pubs and speakeasies, because that's never something that's not fun, right? Just having a place to come and have a good drink. And then what I would end with here is the one tenant that is, I feel, going to be very prevalent. It certainly already is a conversation point among residents and prospective residents, is wellness, wellness, wellness. And by that, I don't mean working out, I don't mean fitness. It is a holistic approach in your building of what can the building do for your resident to improve their quality of life, their health, being mental health, physical health, emotional health. And there's many ways to translate that into a tangible outcome of like Fit Well certification or Well Building certification, but really keep that in mind, and the return on your investment, especially when that's a marketable feature, is the wellness aspect, the healthfulness of your building. And with that, yes. Now,
Thank you. Thank you.
sorry to steal the intro
Stefan,
there.
please.
All right, we can move to the next slide, please. All right, here's a generic slide of facades. So what I'm going to be talking about is primarily the outside of the building, what keeps your building insulated and weather tight. What we're doing to kind of combat these external issues that are happening around us is to kind of look at how we can prefabricate more and more as time goes on a building. Specifically with the facade, we've got lots of local contractors and lots of really talented subcontractors around our country that are going through a lot of R&D right now and creating some panelized systems that don't really sacrifice any of the aesthetics that our developers are looking for, but these units come prefabbed in manufactured facilities that are climate controlled with superior quality control, because every day is 75 degrees in their manufacturing facility. And they can control that quality a little bit better, order materials earlier, store them somewhere before we have to ship them to a job site. More often than not, most high-rise apartment buildings in Minnesota, specifically high-rise, are being built kind of more stick-built, where you could have up to 4 different contractors, one doing framing, insulation, another contractor coming in to do your weather barrier, potentially another contractor installing your windows, and then finally your metal panel contractor. Not only is that a big, somewhat waste of time, what we're trying to solve here is how can we cut costs on right-of-way, street closures, things like that we don't really think about at the beginning of our job. We're just thinking about material costs. But in the city of Minneapolis, over the last year, they passed some new laws that increase the rates of what it costs for a sidewalk to be closed if you've got a swing stage or scaffold on the exterior of your building. Sidewalk closures went up 7 times last year. So it's not a shock for developers to have to spend $1 to $2 million of their own money just to close down street sidewalks and bike lanes, just to build a high-rise building. So that being said, we're looking into prefabricated panels where you can basically, this is an example of the Wells Infinite Facade System, a lightweight precast facade that you can ship these panels pre-glazed with glass to the job site in about 2 to 3 days. You get a whole floor done. You only need a contractor to come back and caulk your joints. And that creative solution causes us not to have to close down streets and sidewalks, saves the developer money. You can really work with costs with your architectural team and developer team. You'd have to do that at the conceptual phase, because to save money on materials, which you can with a system like that, you'd need to optimize the panel size and things like that. You can't just design a building, design units, and then think that this is going to be cheaper after you go out for bid. It becomes kind of a design assist program early in conceptual phase to get this to pencil out even cheaper than the stick-built product I'm talking about. So long story short, to add to what Joyce was saying, in order for something like this to work, developers are going to need to make financial commitments, reserve their spot in line in manufacturing facilities, and we're going to be talking about modular in a little bit, which is kind of the same concept, volumetric modular, where if you can make those financial commitments up front and not wait till you're fully entitled and everything to start a project, that's how you're going to be able to realize the savings. And I'll just touch on one more slide here on the next one. So modular, when it comes to panelization, doesn't need to be precast like that system I showed before. Here's some other examples here. On the top left is in New York City. It's the tallest volumetric modular building in the world. And believe it or not, I just want to give a shout out to a company called McGrath. They designed an exterior panel system where they can apply it to the volumetric pods in the manufacturing facility, and it has a gasket around it. So when you pop those pods in place, you don't need anybody to come in and caulk the exterior of the building. Once the pods are set, it's weather tight, it's fire rated, it's ready to go. So there's a lot of R&D and happening most on the east and west coast right now that's migrating towards where we are. That's really exciting, and I think the more that we can manufacture and prefab ahead of time, that's how we're going to save costs on construction going forward.
Thank you. Michael, please.
All right. I'm just going to take a minute just to talk about dealing with this question of how do we deal with all these things that are coming at us. And one of the things I thought about is just how are we dealing with this as a practice. And we set out, we were founded here 45 years ago, and we're diverse in the different types of things that we did, from multifamily to corporate to government, that kind of thing. We were also a holistic group. Even when I started 35 years ago, we had multidisciplines within our practice. At 16 people, we had architects, a mechanical engineer, an electrical engineer, an interior designer, a marketer, a construction specialist. We grew to about 40 people, then 100 people here in Minneapolis. We were, frankly, on the multi-housing practice, we were competing against ourselves, so we decided we had something good to offer, and the talent in this community is super high, and a lot of very good design firms, and so we felt the need to try to go other places, and we expanded 15 years ago to Chicago, 10 years ago to DC, and most recently in Dallas. And part of that was out of necessity and to try to do things differently. And we've expanded our disciplines. We're over 200 people now. We have a practice site in Vietnam as well. Part of this is dealing with how do we deliver for our clients and the communities that we're trying to design and build. And it's important to be diverse and have all the faculties available, meaning disciplines and experts in-house is one of the things that we really tried to do. And we can borrow and put teams together from these different sites where they have expertise and build teams appropriate to meeting the needs and challenges that we have today. We'll provide design issues and challenges for our Vietnam group, and we'll get that back the next day. It's a way to speed up delivery. The last year, I assume everybody was in the position of, we were crazy busy from a designer group trying to deliver projects, and this was a way to try to deal with that. We're frankly in a bit of a lull right now. And that makes us all nervous, I think. So how do we continue to better ourselves in this period? While for us, and I assume a lot of people, we're trying to create better standardization of our details and processes so that we can spend our time on delivery and the challenges of design and having to turn on a dime and change and flip the thing over and try to design it again because nothing pencils out. And so I think that's where we as designers can help the industry out. Joyce had up on her slide the idea of being adaptable and flexible. And I think that's the main key here is to be creative in how we approach these designs so that we can turn on a dime. Materials change, like we were saying, every week it might be different, or every month, and we have to be flexible to be able to come up with something else. So as a part of our design process, we are always talking about back pocket ideas. Okay, if this material doesn't work, what can we put in its place, still maintain the quality and what we're trying to deliver as homes for these people, and maintain what we set out to do in the big ideas. So that, as a practice, is part of what we did. Up on the slide here, being creative also means being innovative. And so the two projects on the far left, we set out, again, about 12, 15 years ago to come up with a non-proprietary design for light gauge steel construction to create higher density in our urban cores. We're filling up Minneapolis and St. Paul with a 5-story or 6-story 5/1, 5/2, and that was maxing out. We were filling our downtown with that. And so we were looking for ways to do something different, create greater density at a lesser cost than going right to concrete. So this was something that we did. These are two recent projects. One is Madeira Katy Trail in Dallas, and the other is the Finn in Elmhurst, Illinois, a suburb of Chicago. And these were both light gauge projects that were able to be erected as modular elements in a short amount of time and get to market quicker. And so these are just some of the things that we're trying to do and our industry is trying to do. The upper right photo is of Duffy Lofts that recently completed in the North Loop in Minneapolis. Again, this required a lot of creativity and patience and changing. The middle building, which was a open steel warehouse building, we were able to shove 4 levels of parking in and still keep the front street piece available as the iconic element to that whole project. It has a coffee shop in there. You should visit. It's really good. But to get 4 levels of parking and still have lofts on top in the back of that building, we used a Delta beam system. It's a very thin concrete and steel system that allows for really thin floors. We always talk about trying to be real thin and economical, and this was a great way to do it. Probably the largest Delta beam project in the Twin Cities. The lower right just was an example of a student housing project we did in Wyoming, where the labor wasn't available to build in a traditional wood frame sense. So we used SIPS panels and designed the whole thing, shipped it out, and were able to erect it in a very short amount of time. So these were things that we've continued to try to do, and I think the industry is doing, to try to think about different ways to be creative and get these projects built. The next slide, real quick. This was touched on the last panel as well. The idea, our whole way of working and doing things was upended in the pandemic, and how we work and how we interact has been a real big deal. It's meant vacating a lot of existing office space. And so what do we do with that? How do we maintain our vibrancy of our downtowns that are key and essential and have the infrastructure already in place and built? And what can we do with these projects? The Landmark Tower on the left side, Trevor had talked about that on the last panel, but this is really important. This is a 1980s curtain wall office building. We got creative, and it's on the National Register of Historic Places, and is getting historic tax credits to be able to do this. It also has a unique and very good floor plate layout for housing. And so that's part of what makes this successful. There was an article in some documentation just that came out in December, and there's a lot of articles on this idea of adapting office buildings and real estate. But it noted, for instance, in Washington, DC, about 1 in 20 office buildings would be adaptable and a good use to convert to housing. So it's not every office building, not all of them actually work, but there are some that do. There were over 218 conversions from the time period of 2016 to 2021 across the country, and about 40% of those were able to be converted to multifamily. So we have a housing crisis, we have affordability issues. This is an opportunity if we find the right projects and right layouts and that type of thing. The other example, Sioux Line Building in downtown, that was an office building converted into housing. The upper right photo is Press House. That's a mid-century modern office building in St. Paul that we converted into affordable housing using both historic tax credits and low-income housing tax credits. And then the Octave, again, was another mid-century modern office building in Washington, D.C. that took advantage of some of those to be able to be creative and help try to solve the housing crisis. Thanks.
Thank you. David?
All right, the joys of speaking last, where all your wow moments have been made. So today I'll be talking mostly about modular construction. And one might ask the question, how many of you have had a project that's modular or offsite constructed? And the answer will be all of you soon. Not saying that it's going, traditional construction's going away, but as prior panels had mentioned, our workforce is getting smaller. So how can you do more with less folks? The answer, you put them in a conditioned environment where rain and weather aren't affecting. They're more productive because all of the pieces are there, and you can get more done more rapidly with less folks. So talking about some of the design aspects on how you have to think around that. It's not revolutionary, but you do have to kind of hone your craft and know what your tool does well. For instance, traditionally in multifamily, we'd be thinking about what's the unit size and what's the width of the living room we want. And the only thing restricting it is just where you stop drawing. This one, you have to think about DOT regulations. It has to drive down the highway, it has to fit under a bridge. So we start looking at better proportion sizes. So for instance, 16 feet is roughly the width that you want to stick to. Don't have an 18-foot wide living room or a piece like that. And you start readapting, and therefore, it makes a lot of sense. The picture that's up right now, that happens to be Pentagon Village Apartments, which is right across the way, right on the other side of 100. Go see it after this. They're swinging mods today. They are planning to do 8 today, hopefully more. And what's been interesting about watching it go up, go to the next slide, please. I think that shot that was taken in the evening on Monday night. It's going up fast. I'd stopped by, and right when they started, I'm like, oh, there's a couple. I happened to be by a couple days later, and I actually giggle like, holy cow, that thing's going up fast. And you see 2 of the wings that are visible from this shot. They are on the 3rd wing. So basically, next week or maybe early the following, all the mods are gonna be in place. So they really do go up fast. It's entertaining to watch. The mods that Rise produces are as complete as they can be. In a perfect world, the interior of the unit has the appliances, the flooring, all the trim, and then they get in and just do minimal connection aspects and things like that. Due to our fantastic supply chain right now, I know that they did not ship the appliances in it because there were no appliances to have. So they will be going in like a conventional building, but it's something that we'll all get used to. It does, if you plan ahead for it. So for instance, I do a number of feasibility projects on sites, seeing what fits, how it works out. I now know the common multipliers, for lack of a better term, between modular and conventional. So it's quite easy to lay it out with the modular constraints in mind. And if it doesn't go that way, it's easy to construct conventionally. But it's harder to go the opposite way because there are some aspects. So all of the feasibility layouts we do can kind of start that way if that indeed is something that the owner wants to take an advantage of. Last aspects about, I'm trying to think if there are any revelations. The last thing I wanted to mention, if you want to go back one image, is just because they're modular does not mean they have to be simple. And the goal from the beginning of this project was, if anyone drives by once it's done, if they say, "Ooh, is that one of those modular buildings?" Well, we failed. It should look just as nice as any other building we design. It can be articulated. It can have different wings. That's the reason for the early rendering with that that pool level, is to show that it can look like a lot of the other products we're putting up in market rate, and has all the amenities. Like I said, the hopeful goal is when you're outside or in, you don't know it's modular. It just gets built on site really fast.
Thank you. Hey, Todd, I'll do a little quick spiel for Christian. Todd, do you mind putting up the DJR slide? Because that was most of Christian's work up there. And I'll just give a quick background. He's at the groundbreaking for the MPHA, as I mentioned. So he split forces. I came here, he went there. More valuably, he's there at the MPHA. Like I mentioned, public housing agency, which is a big deal, is adopting alternative construction methods. And this is our largest expansion of public housing since the 80s, and maybe in their history. And they decided to do the scattered site project all in modular units, 4 plexes and 6 plexes, 84 units scattered across the city. So real quick, the Alvera is rise, 7-story, a 5/2, all modular. That we worked on. Most of his panels worked on with rise. MPHA scattered site is with rise. Stinson, they worked on with rise. Mod 42 is our first prototype building. St. Michael is with rise, and Glenwood is under construction in North Minneapolis on Glenwood. Plants in Owatonna, employs 130. They brought really what I call contemporary module construction, multi-family modular of the Twin Cities, because before we had smaller companies like Wausau Home and others that could try to do it. But Rise was geared strictly to create multi-family modular housing, and they've started to change the face of the construction industry, open up the whole market as innovative techniques. Made a commitment, and they're working well. And those panels been involved in various aspects of helping this company grow, and it does work in terms of time. It has. We've proven just that the time cut half, and there's cost savings if there's enough scale to it, and reliability of schedule is critical. So that's just a quick portion of Rise. And I think Dave Wallach is here, and they got a booth, so you can talk to him further on that. So that includes the panelist part. We're down to a whopping 2 minutes before you get your career education credits. Any questions or comments on this or thoughts that anyone wishes to give? Concerns on this situation? Can earn yourself a candy bar. Yes, thank you. Go ahead. Stand up just so everyone can hear you. Okay, you want to go first, or want me to take it? Go ahead.
I'll start some. So it is not less expensive, but it's significantly faster. So the time frame from starting construction to actually getting rent and things, that's at the moment, that's the big plus. Do you have other aspects?
Yeah, I just say, we've cut the construction time 50%. In a high interest rate environment, that's a big deal. So these projects we've been doing that you see used to be behind there, we've delivered them twice as fast. And the same that's happening with Cunningham's project in the Pentagon Office Park. That's been the big savings. The other has been the aggregating of materials to prevent glitches of delivery. So It's worked very well. Cost savings only with scale, but the time savings, we've done enough of them now, I can say without hesitation. It's cutting construction time in half because it's a dual path process. Foundation goes in the same time and utilities as the units are being built. And that has worked very effectively, keeping schedules.
I can add to that too. If you're looking at like union labor rates versus non-union, there is a savings there versus union because of the labor rate they get in their shop versus what we get for union labor rates or prevailing labor in the field, to the tune of maybe 10%.
Yeah.
So
That's a good point, because the Alvera was built in front of the Union Hall in St. Paul. And we struck a deal, anything off-site is rises, non-union, any stitching done on-site is union, and that worked out. So that was the process of it. Yeah, he gets his candy bar on the process. Any other questions before you wrap up? Because I know it's one. Anything burning otherwise? If not, we'll be here to answer questions afterwards. Great conference. Thank you, everyone, for attending. Get your credits. Great panel. Thank you.